the supply chain issues have been resolved post-pandemic. How much have they not been resolved post-pandemic due to some of the conflicts that we've seen, particularly in the Red Sea?
Hey, it's great to be here. Well, it seemed like we got things resolved last year in 2023, but ever since these Houthis started disrupting shipping, as you were just talking about, through the Red Sea, it has really dramatically lengthened the time to deliver cargo, which is a reduction of supply of shipping capacity, and that has led to huge price increases. Right now, if you want to ship a container from, call it China, to here in the UK, where I am right now, it costs you about $10,000 unless you have a contract. And by the way, most of those contracts that were signed at lower prices are not being honored. They're adding extra charges to them. So yeah, we're right back almost where we were in the peak COVID situation.
Hold on a second, pause. That's actually pretty profound. We're almost where we were at peak COVID. Are you saying that we have not yet seen the bulk of some of the price increases on goods tied to supply chain disruptions, akin to what we saw back then, because people haven't really maybe internalized some of the delays?
Well, I'm not making a prediction about the future. I don't know if it's going to keep going up. And during COVID, we got where we are now, and then it just kept going and going and going. Right now, there's a lot of extra ships in the order books. These ocean carriers on the container shipping side ordered just a ton of more container ships. We're seeing about a 30% increase in the shipping capacity, the container shipping capacity for the world. And that's going to come online throughout the balance of this year, next year, and into 2026. So because there's so much more supply, people feel like, hey, after the next few months, we get through this current demand surge, then there's going to be enough supply and prices will come back down. We didn't have that in COVID, but we're kind of in those early days of COVID. I mean, $10,000 containers is something that we never saw until COVID for the last, really since the invention of the shipping container.
How concerned is the shipping world with the Red Sea right now?
Oh, I mean, it's on everybody's mind. It's causing delays in getting cargo delivered, in addition to the price. And delays mean you lose sales. You miss holiday season, or you miss some planning, and not just the Christmas holiday season, but we have Mother's Day. There's all these other holidays, and if your cargo doesn't arrive on time, you may not sell it. You've got seasonal goods, or just customers waiting for an order, and you might lose that. You might lose that order to someone else who did a better job planning or understood better. And that's where technology can come in, is give people visibility. When is stuff going to arrive? How do you plan it? How do you coordinate it?
When you see a morning like today and you see a coal carrier being sunk in the Red Sea and you see rates going higher, can you project how much higher they're going to go?
I can't. If you could, you'd probably work in Wall Street in a hedge fund doing something else. We try to be ready for whatever the world throws at us. It's crazy to see the video footage of that ship getting sunk. Most of the container shipping lines are going around the Cape of Good Hope. They're not braving the Red Sea as that ship did. So we sort of have a little bit more predictability about when stuff's going to arrive and what's going to happen. But it's just very hard to know. You're talking about demand and supply, and there's a lot of factors pulling demand forward. People buying more stuff now to get it in before tariffs hit. We've got a potential strike on the East Coast of the United States, and companies are trying to get cargo in before that hits. And then just if prices are going up, you should try to ship stuff as soon as you can, which leads to a cycle which causes prices to go up. So there's a lot of compound factors that make prediction really, really hard.
But as you say, Ryan, I mean, we're nearing some of the levels we saw during COVID. What scars do we still have from that period? Is there anything that shippers, importers, what have you learned that's changed behavior this time around in a time of tension?
Yeah, you know, during COVID, it was really unprecedented. It never happened before, and people were not prepared. When the price went way up and carriers said, hey, I'm not honoring this contract, the price has gone way up, you have to pay this higher price, people got very emotional, very upset. If the same thing happens now, they just remember, oh, that's how this works. The other thing that happened is a lot of ocean carriers signed long-term deals during COVID, long-term meaning 2 or 3 years, at a price somewhere in the middle. Like the market price was $15,000, normal price is $2,000. They said, hey, I'll do it for you for $5,000, but you have to agree to pay that for 2-3 years. Almost no company in year 2 continued to pay. They all came back and said, no, we want to go back down to the lower market price. And so these carriers remember that too. So it's a two-way street, and ocean carriers are saying, hey, you didn't pay the higher, you weren't willing to pay above market price, so now you have to pay at the market price. I'm not giving you a discount. And I think that's fair, actually.
So, okay, some of that's still ongoing then from COVID. But I can't help but wonder, Ryan, you talk about the other disruptions that shippers are trying to get ahead of: labor issues, strikes, tariffs. I know you're likely to tell us you're not in the business of making predictions, but I want you to try. Should those things come to fruition, should we get continued Red Sea attacks, plus tariffs, plus labor disruptions, how bad could it get?
Yeah, I mean, the one that could get really bad is the ILA. That's the union that operates the ports on the East Coast of the United States. Their contract ends September 31st. So if they were to not strike a deal, and just a couple of weeks ago they called off negotiations, trying to learn more about the automation strategies of these port terminals and ocean carriers. They don't want to see robotic ports. They don't want to have their jobs impacted. If they were to go on strike and you couldn't import a container through the East Coast, it would definitely create massive chaos. You'd have to move all cargo into the U.S. through the West Coast. It's not just the East Coast, by the way, it's the Gulf Coast as well that the ILA operates on. You'd have to move all the cargo through the West Coast. Those ports would be congested. Those ships would all be full. By the way, you can't just reroute a ship from the East Coast to the West Coast. The West Coast Union won't unload a ship that was meant to go to the East Coast out of solidarity. So you would see prices probably exceeding what you saw during COVID, and supply chain transit times be even worse. So that's probably the big outlier, worst case scenario. Hopefully, you know, the September 31st is what, 30 days before the election, 34 days or something. So hopefully the government and Biden administration kind of at least would want to hold it off until after the election. It seems like it could be a real problem for them. The other things, tariffs, et cetera, we've seen a lot of that before. Might actually, you know, reduce demand, which would cause price of shipping to come down. Bad for the economy. I'm not sure it'd be bad for the price of shipping. It would probably help companies that are moving goods, especially if their goods aren't hit by these tariffs.
Ryan Peterson, founder and CEO of Flexport, thank you so much. It is all about logistics, and it will continue to be, especially as we talk about inflation coming up. We're going to be having that conversation about inflation and just why it may remain sticky, and that's kind of a crucial part of that story. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackett. Yahira.
Hi, Lisa. China is loosening its grip on the yuan, setting its daily reference rate at its weakest since November as Chinese banks held lending rates steady. The move coming as the dollar moves closer to this year's peak, with traders betting on higher for longer rates here in the U.S. The People's Bank of China governor signaled there is more room to ease monetary policy as other economies are pivoting to cut rates this year. It's been a tense week between Israeli Prime Minister Benjamin Netanyahu and the White House. Netanyahu released a video criticizing the U.S. for withholding deliveries of weapons and ammunition. And in response, the White House reportedly canceled a meeting with Israel scheduled for today where they were meant to discuss Iran. In a follow-up, the U.S. ambassador to Israel told Netanyahu the weapons are in the process of being delivered to Israel. And a cyber attack shut down thousands of dealerships across the U.S. over the Juneteenth holiday. The incident targeting CDK Global, the software provider many dealers rely on for almost all their business. According to a cybersecurity firm focused on the auto industry, the outage left some dealers unable to function at all, and some even had to switch to paper for routine services like oil changes. The firm says that some CDK functions were restored by the afternoon, but the service is still not fully operational. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, decision day for the Bank of England.
The bank has to say on a forward-looking view that inflation is likely to pick back up, and therefore it is unlikely to go on a big cutting cycle.
That's coming up next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Are we there yet when it comes to the rate cutting cycle? We will find out. Under surveillance this morning, decision day for the Bank of England.
What you have is temporarily a inflation rate that looks in line with the Bank of England's 2% target, but it is heavily influenced by goods deflation. That is unlikely to persist into the end of the year. So the bank has to say on a forward-looking view that inflation is likely to pick back up, and therefore it is unlikely to go on a big cutting cycle.
Here is the latest. The Bank of England rate decision due at 7 a.m. Eastern. Sticky services inflation and the upcoming UK election likely to keep the central bank on hold, even as the CPI fell to the Bank of England's 2% target for the first time in 3 years. In a paper for the Brookings Institution, Pierre Yared, a professor at the Columbia Business School, writing this: 3 trends will make it harder for central banks across the world to keep inflation low and stable: deglobalization, fiscal pressures, and rising long-run real interest rates. I am so glad to say Pierre joins us now. I want to start with that idea that this is going to look like a very different inflationary cycle than in the past. How feasible is it that what we're seeing right now with rates, with inflation coming down to central bank targets, is highly temporary, and we could see inflation retest some of the recent highs?
Yeah, our view is an out-of-consensus view that even though inflation will come down in this cycle, that it's likely to be higher on average and much more volatile in the foreseeable future.
How much higher and how much more volatile at a time where people are wondering if R-star is the right way to think about it, or if just a completely different inflation cycle is a better way to think about it?
I would say it's a combination of both R-star, meaning the real interest rate as well as, in real terms, as well as inflation expectations and inflation volatility. And we see that as getting baked into longer term rates, even as short term rates come down.
It is definitely out of consensus because this is not something Fed speakers are talking about, right? The language right now is let's wait, let's see, we need more data, whatever. What would it sound like to have Fed speakers acknowledge this? How should they be talking and thinking about this problem?
I think that what Fed speakers need to do is to double down on their commitment to inflation stability and targeting inflation. What we're talking about is the difficulty of the job of not just the Fed, but central banks broadly across the world in dealing with these pressures. Over the last 30 years, they've had a tailwind that has made their job a lot easier. And right now, in the next 5 to 10 years, we see a lot of headwinds that are going to make their jobs a lot harder. And some central banks will do it better than others.
What's the combat to that? What's the antidote? Because you could see a world where you get these inflation spikes and you have some quick draw reactions where someone hikes and then you cut because it's this volatility. So what is the right framework? What is the right reaction function?
That is a very good question. We certainly don't want to be in a world where interest rates are also volatile because central banks become trigger happy. And what we want to see is stability, and what we want to see is very good communication. The Fed is engaging in another strategic review, and my recommendation is to double down on the importance of maintaining stable inflation and also to clarify what the employment mandate also is, which is that it's a level of employment that's consistent with inflation stability.
Pierre, about a month ago, Adam Posen sat in your seat and said the Fed right now should be laying the groundwork for hikes in 2025. Do you agree with that?
I think that we do not know what will happen in 2025. There are a lot of shocks to the economy. I do think that the Fed should remain flexible, and it should make it very clear that it can cut or it can hike, and that really depends on the data that it sees.
When you say 2025 is unpredictable, is that because of the politics?
In part because of the politics, in part because part of the reason we saw all of the increases in inflation is because of the types of unpredictable shocks involving supply chain, which you talked about previously, as well as other issues involving trade policy, which can also lead to spikes in inflation.
So Ken Rogoff, the Harvard professor, was singing your praises, saying that you really were the primary author on this study that I believe is going to be heavily discussed at Jackson Hole in August, at a time where central bankers are trying to communicate well, but they don't exactly know what they're trying to communicate because they're not sure of what the parameters are. What do you expect some of the discussions to look like at a time where there is this great uncertainty? You could see it in all of the iterations from the Federal Reserve, and they're trying to provide guidance, but it's just becoming, I'm just going to editorialize here, kind of noise.
That's a really good question to think about how to effectively communicate. My view on this subject is that they should be communicating that they are watching all the possible different shocks that could occur to the, not just domestically, but internationally, and they should be ready to react if there are pressures.
But what kind of reaction? I mean, how much do they have to start talking about reaction function and what it looks like in terms of, scenario analysis, more so than, say, we're going to cut once or cut twice, or we're going to just be data dependent, which could mean anything depending on who you are?
I think a reaction function approach is the right way to go. My preference, relative to what is currently communicated, is to have a scenario analysis view, which is that if this happens, this is what we do. If this happens, this is what we do. That's my preferred approach.
I want to take some of this idea of the volatility of inflation to its logical conclusion, and that is uncertainty in this market of how you price in inflation, what that does to long-term yields. I know you've written that it would just be reflected in higher borrowing costs. So when you look at the economic impact of an uncertain market, how does that play out? How much more tight do things look just as a factor of the unknowingness of volatility of inflation?
Well, it should show up both in the levels and the uncertainty, and both of those can show up in risk premium. So I would say that long term, you see higher borrowing costs for households, you see higher borrowing costs for corporates, and given the CBO report from yesterday, you see higher borrowing costs for governments. And there's a lot of uncertainty that comes from that.
When you look at the higher borrowing costs, the U.S. deficit, this is at a time, to Greg Vallier's point this morning, this is a time where we're having economic growth. We're not in the pandemic. What would this look like if we actually needed that fiscal impulse to solve something like a recession?
My concern when it comes to the fiscal trajectory is exactly the problem that could arise if a government, and perhaps the U.S. government, doesn't feel like it has the fiscal space to react to some kind of emergency situation.
Pierre Yared of Columbia Business School, thank you so much for being with us. We really appreciate it. And to your point, Anne-Marie, that CBO report, it came out on Tuesday showing that the federal debt would equal about 122% of the U.S.'s annual economic output by 2034. That far surpasses the high that was set in the aftermath of World War II.
Right. And from February to now, they upgraded $400 billion was added to this. A lot of this has to do with defense spending because what the U.S. is doing with Ukraine, also Biden's path for student loans. A lot is being added. And next year, regardless of who's going to be president, there's going to be more added to the fiscal debt.
And I think it is a good point. What happens when there's a downturn? Not just because you don't have that fiscal firepower, but all of a sudden less revenue is coming in. You're paying more with unemployment benefits. You're getting less taxes coming in too. So what does that do to deficit spending? You can say, sure, rates are coming down, so there's less interest to be paid, but other issues arise.
All I can say is, Steve Eisman, you have successfully gotten yourself into my head where I hear you saying, why are you worrying so much? It hasn't planned out, and actually the U.S. has been growing faster than everyone else. We are about 4 minutes away from that Bank of England decision where they're trying to thread a very different needle. It rhymes, but it's different than in the U.S. Coming up next, Evan Brown of UBS, Ed Mills of Raymond James, Jonathan Miller of Miller Samuel, and Macquarie's Terry Wiseman as we break down likely inaction by the Bank of England with a bit more of a fraught backdrop than in the U.S. This is Bloomberg.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The economy seems to be doing well. The data, while mixed, still seems to be showing strong enough.
I think the bull trend continues. It may feel choppy. We may get a pause here in these early summer months.
If you look at the markets right now, there's no breadth, and clearly there are some real concentration risks.
We have to recognize what extreme optimism is built in to the economic outlook that markets see.
If we were to begin to see a series of hotter data prints, I think that's what would cause the market a bit of concern.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
What rate cutting cycle? This is Bloomberg Surveillance for our audience worldwide. Anne-Marie Hordern, Danny Berger, Lisa Abramowitz, John Farrell will be back next week. We are looking at a rate cutting cycle delayed, if not deferred. We talk about what's going on. The Bank of England just now decided, not unexpectedly, to hold rates where they were at 5.25%, and just has kind of hammered home this point that we keep talking about, which is we keep thinking this is going to get started. The SNB, Swiss National Bank, is saying, let's go. And everyone else is like, we just aren't sure, Danny.
Well, some of the confusion is in the language we're hearing from central bankers themselves. Of course, we won't literally hear from the BOE today because of the election. They're in a blackout period. But looking at this, BOE notes upside news on service inflation, weak core goods. But in the same breath says, some downplayed the threat from services CPI and the wage hikes. So even they can't get it together. Even they don't have a clear message that makes us confused and makes us wonder, when is this cutting cycle beginning?
Well, and Andrew Bailey, the head of the Bank of England, saying that they need to be sure inflation will stay low. This is a whole question on confidence. We'll get to Lizzie Burden in just a moment to break down all of the headlines. At the time when it basically came in as expected, a 7-2 split vote, which is what people were broadly looking for. But this comes at a time, and Anne-Marie, this is really the key issue that we see the Bank of England also grappling with. We're sort of staring into the sun, as Lori Calvasina says, when it comes to some of the geopolitical risks, the internal political risk. Central bankers want to say it doesn't matter, but it's very hard to say that when ultimately who gets elected will really have a big influence on the fiscal overhang and what the deficit looks like.
Absolutely, and they're coming out today saying the timing of the election, the UK election, which is going to be July 4th, didn't interfere with their decision today. They said it wasn't relevant. I think that's a little bit hard to believe, because to say that political election is not going to take up space in this debate on when the trajectory of the country feels fraught and difficult. But it's the same debate people are having here in the United States, but even some saying potentially we'll get a rate cut the day after the U.S. presidential election.
Which all goes into what the sort of unknowns are. Right now we're looking at markets that we're expecting this decision, and our little change we're looking at it, although the pound is a little bit weaker on the heels of this. S&P futures still up 0.4%. The euro around the same where it was before, 107.28. 10-year yields up just about 2 basis points, 4.25. Rounded up, and crude just marginally higher as we head into a driving season. Coming up, Evan Brown on UBS on the Bank of England decision and why he may like England and the European Union more than the U.S. Ed Mills of Raymond James with the first presidential debate 1 week away, and Jonathan Miller of Miller Samuel on the state of the U.S. housing market. Lizzie Burden of Bloomberg has been parsing through all of the headlines. Lizzie, with the Bank of England, what stood out?
Well, it's interesting, as Anne-Marie commented, that they felt the need to say this was nothing to do with the politics. Indeed, we haven't had any speakers from the Monetary Policy Committee since that snap election was called, and you can imagine the optics of cutting for the first time during the election campaign. It would look as if the old lady of Threadneedle Street was giving Rishi Sunak a helping hand. Whether it would work or not is another question, but as they say, it's not political. I would just look back at history, though. In 2019, during the campaign, you had 2 of the Monetary Policy Committee voting to cut regardless of the campaign. And there's also an argument, isn't there, that opting not to cut could be a political decision. But let's put the politics aside, because there were other factors here at play. We had that services inflation reading yesterday coming in unexpectedly hot, and there was this vision on the committee about how to interpret that as well. You had some members actually seeing a risk from second-round effects from this services inflation, others actually playing down the threat from services CPI. So that's interesting. And the final thing I'd note, Lisa, is you had the same vote split as last time, 7-2, the 2 dissenters who want to cut now being Dave Ramsden and Swati Dhingra. But I'm looking ahead to the next meeting. Bren Broadbent, the Deputy Governor, has voted today for the last time. Next time he'll be replaced by Claire Lombardelli. She's thought to be more hawkish. So do we actually get a different dynamic on the MPC?
For now, Lizzie, this market is interpreting it as dovish. I'm not really sure how, since all we've gotten is a few statements, and some, as you point out, are contradictory. Sterling down about 0.25%. Traders are adding on to the rate cut bets at this moment, pricing just under 50 basis points of cuts this year. But Lizzie, we are a long way away from the Andrew Bailey of the start of the year, who said we're turning a corner, and that corner never came. When you talk about the vote split, 7-2, how far away does this MPC seem from being willing to cut?
Well, you say 7-2, but don't think about the members of the Monetary Policy Committee as individuals, because you've got that big block of internal members who seem to move as a pack. So wait for the likes of Sarah Breeden, the governor himself, to go for a cut, and it could seem a bit more rapid than at the moment it seems. But yeah, traders off the back of the services print yesterday really paired their bets on an August cut. So it's interesting that actually now, having seen the decision and the guidance around it, as you say, looking a bit more dovish.
Lizzie Burden, thank you so much. Great work, as always. We'll be catching up with you as we parse through this, because it does matter. Ultimately, the Bank of England is dealing with a lot of the same issues that the United States, that the Federal Reserve is, and many other central banks. And it raises the question of, to your point, Anne-Marie, how much do they have to basically say we're not be letting politics affect us, because they have to kind of factor that in? And how much are we looking at as something of a split decision with confusing results in markets? Evan Brown of UBS joining us now to give us some clarity. Evan, what do you make of the Bank of England decision, not just for England, but just more broadly on some of the tensions right now among central banks?
A lot of tensions with central banks. I mean, services inflation in the UK just staying very sticky. That makes it tricky. But at the same time, you're seeing employment weaken. I think in the end, they'll come down to concerns about the labor market and see that as first, and inflation more as a lagging indicator. So they hold off for a little bit. Same with the Fed. You know, they're not jumping right in like the ECB did. But ultimately, their next up is an ease. It may happen in August. It may happen in November. I think for global markets, that doesn't matter that much. But at least we know that, you know, we're heading in the right direction on inflation. And I think that's you know, a decent environment for gilts going forward.
The rate cutting cycle strikes me as an old car that's been left out for too long, and you're trying to start it, and it's kind of trying to crank up, and it just never quite gets there as quickly as you would like. How can you be bullish on assets in Europe after a lot of people were saying that the argument would be a rate cutting cycle that would be more aggressive than in the United States? And now people are questioning whether that's actually the case, given some of the challenges that you were just talking about.
Yeah, so our optimism on Europe is actually less based on the rate cutting cycle. I think that's a positive, but it's more about just really what's an organic recovery happening in Europe. That you have had inflation fall reasonably fast. You do have real incomes improving. You do have global manufacturing picking up, and then the rate cuts are kind of the icing on the cake. That's how I'd see it in Europe. So, and I think that's still the case. We've got obviously some political noise, and you know, Macron calling a presidential or calling for an election was not on my bingo card on you know, ahead of the EU elections. But in general, I think the macro fundamentals went out, and we're still positive on Europe here.
You called it election noise. Is it that? Is the politics just noise at this point?
I think when we take a step back, you know, work backward, right? What do we really worry about when we look at these, you know, more extreme parties taking hold? This is not 2011 or 2012. Whatever the outcome is, you know, Le Pen wins an absolute majority. France is not leaving the Eurozone. That is not happening under any scenario. Now there might be a little bit more fiscal spending, and that might create some issues for business confidence and the like, but it doesn't stop the underlying, you know, picture of an improving economy. And I think, you know, the French people in business, they're probably more worried about their star player Mbappe and being injured than they are, as we all are, right? than they are about this election and in terms of what it means for the economy itself and confidence.
Can you look through the noise the same way you are in Europe, in the United States?
Yeah, you know, there's a lot. The U.S. election is very tricky, and we really, as asset managers, have to think about it in terms of risk management as opposed to trying to really position for a particular outcome. I don't know that the election is going to have a meaningful impact on the Fed's decision making. If we see, there's a lot of data between now and September. If we see inflation coming down, if we see the labor market continue to cool, they're going to go in September. The Fed is not going. The election is not going to stop that. I think after that, seeing what the fiscal situation is, seeing where tariffs are, you know, then they'll have to take a step back, and maybe it means that they don't cut as much as they originally planned, independent of the election results.
So if you're not going to position for the horse race, how do you though hedge for all these risks you are concerned about?
I think the dollar, it has been and remains the best risk for, or the best risk hedge for a lot of scenarios. And if you think of a broad equity bond portfolio, those moments where you get an inflation surprise or a concern about you know, bond yields rising too much in the U.S., or now concern about Trump and tariffs or broader geopolitical uncertainty, it's always been the dollar that's been the most dependable hedge, and you just want that overlay, whether you're trading FX independently or whether you're just, as a U.S.-based investor, hedging your international exposure.
When we talk about the deficit and this huge expansion that we see over the next 10 years, more than had been assumed from the ONS yesterday, there is this idea that essentially it means duration becomes less attractive, that yields have to go up in order to absorb that supply. But it's also a time now where there is demand for duration because we see the Fed cutting, we see the economy weaken. How do you see these two opposing forces?
You can count me among one of the people who's a little more relaxed about the fiscal deficit thing. I mean, no one feels great about the fiscal trajectory that we're on. But when it comes down to it for markets, right, in Q3, when yields were surging, right, and everyone was worried about the fiscal situation and the auctions and everything, all it took was a hint of a slowdown in inflation and a hint of a slowdown in growth. And all of a sudden, bonds are rallying like crazy. And so as much as we talk about the supply, and the supply matters, there's still so much demand for U.S. duration. It is still the safe haven asset for the global economy and for global markets. And that's what people are going to come back to. We are the reserve currency of the world, and there aren't that many alternatives that are attractive. So, you know, I think about the fiscal deficit. You know, I'm aware, I know it's unsustainable, but in terms of this idea that bonds are going to just suddenly sell off like crazy because of fiscal concerns, I'm just not in that camp. It doesn't take into account the sheer demand for U.S. treasuries.
I love this. People who would talk about not being that concerned have to say, I care. Everyone cares. It's really a problem. It just, you know, long term hasn't proven to be that much of an issue. You talk about relative expectations, and that's the reason why you see potential outperformance by Europe, because the expectations are lower than the U.S. We started this show with Jonathan Stubbs of Berenberg saying that one of the reasons why he also is more positive on Europe than the U.S. is because of NVIDIA, is because there seems to be these sort of runaway trends that are making him nervous in terms of valuations. Do you agree that NVIDIA kind of makes the U.S. less appealing at this point, given where valuations have gotten?
So I would say, I wouldn't say I like Europe more than the U.S. I'd say I like them both. You can't stand in the way of that freight train of mega cap tech. You just can't do it. It's you know, it's a major structural theme. AI. You know, these companies, the earnings power, the potential. No one really knows how transformative this technology is going to be, and I'm not smart enough to perfectly time when, you know, a certain mega cap company just absolutely like hits its point where that's too much and it needs to correct. So I think you have to own U.S. equities and you have to own that theme. European equities just broadens you out, right? It's playing another theme, which is just a broader improvement. But let's keep things in perspective. We now have the mega cap 7, or magnificent 7, in market cap, larger than MSCI Europe and MSCI Japan combined. I mean, that just tells you the scale of these companies and the power of these companies. That's not something that, you know, I'm not trying to fade that. That's not something that's something I respect, as opposed to try to stand in the way.
You're painting a portrait of somebody just sort of standing in front of a couple of, you know, tanks being like, please stop. And it sort of creates this sort of existential question. Evan Brown, thank you so much for being with us. Evan Brown of UBS, we appreciate your time. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackis. Yahira.
Hi, Lisa. The British Navy said a Greek-owned coal ship was completely destroyed by an unmanned vessel in the Red Sea. It's the latest sign Houthi militants are showing no signs of slowing their attacks on international shipping vessels. The attack sent insurance costs surging to nearly double their prior rates, according to sources involved in the market. Families of the victims of 2 fatal 737 MAX crashes are asking the Justice Department to fine Boeing nearly $25 billion, saying the company committed, quote, the deadliest corporate crime in U.S. history. An attorney representing 15 victims' families suggested that $14 to $22 billion of the total amount could be suspended if Boeing devotes those funds to an independent corporate monitor and improvements to its safety program. This coming just a day after Boeing CEO Dave Calhoun faced a public grilling by U.S. senators. And more than half of all banking jobs are likely to be displaced by AI, according to research from Citi. The report said an additional 12% of roles could be augmented by the technology. Citi adding that AI may not lead to a drop in headcount, though, as the need to hire more AI managers and compliance officers grows. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. So, Evan, are you being replaced by AI?
You know, hopefully not. I think unless you're going to have an AI here talking to you right now.
I might be AI.
Great.
That's right. That's right.
Just holograms.
I think they'll still need me to interpret what's going on when the machines are under control.
Under repair. Evan Brown, thank you so much. Under surveillance this morning, setting the debate stage.
Trump has taken over the Republican Party. It's really a populism without any anchor to principles. I'm a big believer that you want your party pledging fidelity to a set of principles and policies that solve problems versus a person. And I don't think a personality type politics is durable.
That's coming up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
A little bit more than an hour until the 2 hours, excuse me, until the open of trade, and we did get that Bank of England rate decision. It was widely expected, 7-2, to keep rates on hold at 5.25%. What you can see in markets, little change in the U.S., up about 0.4% on the S&P. Still, yields just marginally higher, 4.24 in the United States. Over in England, this is being treated, as Danny said, as a dovish interpretation, as the Bank of England does hint at the potential readiness to cut later this year. More on that throughout the day. Under surveillance this morning, very much the focus on the United States, setting the debate stage.
Trump has taken over the Republican Party. It's really a populism without any anchor to principles. I'm a big believer that you want your party pledging fidelity to a set of principles and policies that solve problems versus a person. And I don't think a personality type politics is durable. So I do think at the end of the day, our party, like we have in the past, will have a big discussion about what we stand for. What are our ideas? What are our principles? And who are the best people capable of carrying those ideas forward?
Here's the latest. The first debate between President Biden and former President Trump about 1 week away, with many people speculating on who Trump will announce as his running mate. Ed Mills of Raymond James writing this: "We have seen a renewed interest in the elections from clients and details on the future path of tax policy, immigration, and response to geopolitical events. They'll be closely watching for 2025 policy outcomes." I am so glad to hear that. Ed joins us now. That is what I want to talk about more than sort of the parlor game of exactly who is going to be where and who might do what ahead of the debate in order to prepare. Ed, when it comes to policy, we were just talking about the Bank of England and the fact that they did not cut rates, but they felt the need to come out and say, we don't want to take politics into consideration. How much are your clients taking politics into consideration with respect to deficits and what that will mean for the rate path going forward?
Lisa, this is a huge issue because there's a lot of kind of knee-jerk reactions to who might be better for certain parts of policy. But one thing that we've been highlighting for clients at Raymond James is these twin fiscal cliffs that start as soon as January 1st of next year with the return of the debt limit and then the expiration of $4.6 trillion worth of taxes on December 31st. So I certainly think the market would have a reaction that if a Trump victory were to occur, it's more likely those taxes get extended. But, you know, when we talk about the Bank of England, one question I get a lot is, does the United States have a Liz Truss moment where there's a desire to do some of these things, but is there the ability to do that if there is that movement in treasuries? A growing question that I'm getting is who's more inflationary? And when we look at some of the Trump policies on taxes, on tariffs, on immigration, a continuation of some of the fiscal that has occurred under Biden, are we going to see a second wave, or is there going to be a debate about a second wave of inflation? And does that stop the Fed from cutting? And is it higher for longer there? These are going to be huge debates, not only this year, but throughout next year.
But Ed, as you know, the President of the United States is not a king, and he will have to deal with Congress, whoever it is. And likely what it looks like is we can have a divided government. What does that mean for the rate of inflation?
So, Anne-Marie, I think that's probably where we get the least amount of policy changes. But one of the things that we've been highlighting is that a preparation for a potential sweep is what clients need to do. So if I told you one thing the day after the election, you might know the rest of the story. If you woke up the day after the election and I told you Democrats maintain control of the Senate, that's probably a Democratic sweep, because especially with the tiebreaker, Biden's won re-election and the Democrats have probably taken over the House. If If I told you the day after the election that Republicans defied odds and kept the House of Representatives, that's probably a Republican sweep. We give that about a 40% odds. So those two together are about a 2/3 probability. So preparing for the sweep and preparing for reconciliation, maybe changes to the filibuster, are the most prudent thing you can be doing right now as you think about the election and the impact on the market.
When we think about the election, Fox News had a national survey out. For the first time ever, Biden is seen beating Trump head-to-head since October. What do you think the Biden administration needs to do to try to maintain a polling number like that, especially as they prepare for him to take the debate stage next week?
Yeah, Anne-Marie, I think what the Biden campaign would say is exactly what Joe Biden has said for years, is don't compare me to the almighty, compare me to the alternative. And so as we look to the debate next week, what the Biden campaign wants is to make this a referendum about Donald Trump. If this is a referendum on Joe Biden is underwater in his favorability ratings. Only 25% of the country believes we're on the right track. Those are flashing warning signs for an incumbent seeking re-election. So to the more that they can move it over to that referendum, and then secondly, make sure that Biden can win in the swing states of Wisconsin, Michigan, and Pennsylvania. Because Biden can lose Georgia, Nevada, and Arizona and still have 270 electoral college votes. So it's that focus on that so-called blue wall, but also make sure that this is a shift over to Donald Trump.
Ed Mills of Raymond James, thank you so much for taking that time.
Thank you.
Honestly, this is going to be one of the key issues, is exactly how this plays out. And Danny, to this point, I mean, even if you know who's going to be necessarily the candidate and who's going to actually win, how do you understand the policy trajectory from that?
And then we're just in this vicious cycle where you have a Republican president come in who cuts taxes. You have a Democrat come in and they mostly leave those cuts in place or maybe extend it to the bottom 99%. You have a Republican come in and cuts taxes. It's this cycle that keeps going on and on. The question is what stops it? Is it a Liz Truss moment? Is it an economic downturn? So far, it doesn't seem like that moment of reckoning is on its way.
All of the spending, though, in policy is a small sliver of the pie. Until they decide to deal with entitlements, then our fiscal trajectory is going to be where we are now, which is what some would say a dangerous path forward.
Steve Eisman's coming on next week if anyone wants an Oi the Deficit moment, and the idea that a lot of people agree with him, and everyone's hoping for this Liz Truss moment to inject some discipline, and it seems like a lot of bond investors are saying it's not my job, because so far that has not worked. Coming up, we'll look ahead to U.S. housing starts and building permits data with Jonathan Miller of Miller Samuel. We will also be looking ahead to initial jobless claims. This is Bloomberg.
world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
About 2 hours to the open of the trading day as we take a look at markets trying to have a 32nd record high in the United States, still about up 0.4% on the S&P. It's just shocking to me. We're almost at 5,600. When you think about where we were at the beginning of this year, anyone who said 5,600 would have basically been laughed out of school, being like, what planet are you on? Now you have Ed Yardeni saying 6,000 and lots of people coalescing around him. The Y is in the NASDAQ 100 or the NVIDIA, which should be its own index, up 0.6%. That is the NASDAQ, not NVIDIA. As people take a look at big tech and the Russell 2000, guess what? It is underperforming yet again. Why? Because why not? It seems to be sort of damned if it does, damned if it doesn't, based on growth being problematic. Okay, that's not good, even if yields are lower. Yields too high, that's not good because they're highly leveraged. In the yield space, this is what I'm watching. Basically, coming off some of the earlier highs after the Bank of England decision with a more dovish tilt, they want to get started. They want to cut rates. Everyone wants to cut rates. Danny, we're seeing in the U.S. less than 2 basis points of an increase on a 10-year, 4.24%. Two-year yields up just about a basis point at 4.72. How long can it be before this is like Lucy with the football being pulled out, the rate hike that wasn't, which seems to be sort of the expectation everyone's been stringing along with all of the central banks from month to month to month.
Central bank speak specifically in the U.S. is really not helping. Everybody just saying we need more months of data. If you're Alberta Muslim, it's more quarters of data. So how many of these central banks are really going to be willing to cut when the Fed is not doing it? Sure, the ECB went ahead with it. Sure, the S&B has gone ahead with it twice. But there are consequences. Swissy is down this morning. It is weaker, maybe not to disastrous effects. So do you look at that and say, okay, we can cut and it won't be horrible? Or do you say, we got to wait for the Fed?
Although the Swissy is what they actually wanted to depreciate. They were actually excited to see a weaker currency, and this was the hope and the dream. Let's see how long that works. Meanwhile, you can see the euro softening just a touch versus the dollar. Potentially, though, a little bit less volatile than certainly last week when political risk really got re-injected. You can see 107.31 as people take a look at the idea of the dollar still remaining preeminent despite promises of rate cuts that seem to be delayed in an ongoing fashion. Under surveillance this morning, the Bank of England keeping rates on hold, hinting that policymakers may be close to backing interest rate cuts. Anne-Marie, this really was the most interesting aspect of this, that despite some of the stickiness in inflation, they're still ready to go.
That's to Danny's point earlier, that this really was dovish when it came out. No one really thought they were going to make a move today, given the fact especially that, in a week and a half time, we're going to have a fresh UK election. But what you do see now is traders piling in that the bets for August are now starting to ramp up. So potentially, before the summer's over, we will see this cut out of the BOE.
And that's sort of what people are betting on pretty much globally. Meanwhile, does it even matter? And this is really what we've been talking about. And Danny, you put it well, framing it versus Cisco, the AI rally. powering on, led by NVIDIA. NVIDIA clinching the title of the world's most valuable company after overtaking Microsoft and Apple. Shares rising in pre-market trading. What a shocker. With the chipmakers set to add about $100 billion of market cap. Sort of blink in an eye and you get another $100 billion. It's just sort of shocking. 3.4% because why not? Who's going to stand in the way of this freight train, as we were just hearing from Evan Brown? Danny, at a certain point, how much does this sort of diverge completely the U.S. market from all others and, frankly, from all rate cutting discussion?
I mean, the thing, though, is, and I know you know this, it's not the U.S. market, it's literally NVIDIA diverging from everything. And the thing that I worry about is when you have other corporates looking at NVIDIA and saying the only way we can get this treatment from the market is if we become an AI company, too. You see that with Dell, for example. They announced that they have some deal with NVIDIA to build an AI factory. Surely that can't end well. I'm not talking about for Dell specifically, not a call on them. But if you have all of these companies spending a huge amount of money, all of this CapEx on literally the same thing, they might discover they don't have the kind of moat that they have around their core businesses that they will on AI if they're all doing the same thing.
Dan Ives, though, this morning, popping champagne for sure. He writes, the AI revolution starts with NVIDIA. In our view, the AI party's just getting started. At its 9 p.m. in a party, going till 4 a.m. with the rest of the tech world now joining. The question I think we've been hearing from some people, though, and this nervousness they have, is what happens when the cops come to that party?
Carrying that through, when was the last time that we saw a party of this nature? Again, we just go back to some of the parallels, and I think the Wall Street Journal putting this out over the weekend, I want to say yesterday, was telling. This idea the last time we saw this type of outperformance and that we saw an computing infrastructure company take the helm in this kind of way was Cisco in March of 2000. We know what happened after that. Investors, meanwhile, awaiting fresh U.S. data out in an hour's time. We'll get jobless claims, housing starts, and building permits. This comes after U.S. mortgage rates fell below 7% last week for the first time since March. If you did get a mortgage at 3%, you're probably thinking, at the same time, Lisa, the more that it drops, the more. Jonathan Miller of Miller Samuel writing this. When the Fed does cut, I suspect there will be an outsized pickup in sales, even with only a 25 basis point cut. Many would-be buyers have been waiting 2.5 years to see easing rates. Jonathan joins us now. This, to me, Jonathan, is really one of the most interesting questions, and I love having you on, as always. There is this belief that when you cut rates, you can do so in a way that isn't going to reignite animal spirits. How much of a rate cut? You see only 25 basis points of a rate cut as reigniting a lot of interest in the housing market. So how does that factor into pricing and this idea that we can get a soft landing with rate cuts given the backdrop that we have right now?
Well, I think that outsized response to the 25 basis point cut or a modest cut of some sort, you have to think of the last 2.5 years have been this era of pent-up demand that suddenly the sort of legs were cut out from under the housing market, and people that were in the process of thinking about it were stopped in their tracks, and everybody's waiting. And the problem with the waiting part is that when you have if you have a rate cut and this surge of an activity, I think you're going to see prices rise again. The only way for more supply, that's been one of the reasons why we've had such price growth, is inventory has been very lacking. We are seeing inventory come in, but we haven't seen the same amount of demand respond to it because of rates. So when you see rates cut, you're going to see a surge, at least in the short run, you're going to see a surge in demand. And that's going to keep prices elevated, which has sort of broken all the rules of economics, where we're talking about record prices and mortgage rates are more than double where they were.
There was a theory out there that when the Fed cuts rates, that's actually going to cause more volume to come onto the market. So you'll actually see more houses go out there, which will actually cause prices to fall because you'll actually get price discovery in a way that we haven't had for 4 years. Why don't you believe that?
So let's take a market like Miami, and there's been lots of discussion about inventories coming in. Over the last year, inventory has risen about 38%. So you'd think, wow, prices are, going to be challenged. But that inventory result of after that increase is still 25% below pre-pandemic. So when you look at the percentage of inventory growth, and we are seeing it, and it is good for consumers in the long run, but it's not enough yet. That there was such an incredible deficit of supply that sort of, 100% or whatever the local market number, a big, the sort of headline grabbing increase in inventory is still coming from a record low. And it's not even, I won't say it's not even close, but it's still well below long-term norms. And that's the dilemma. It's sort of, everybody's waiting for rates to become more affordable. But in the meantime, I think we're going to see price growth. And so someone waiting for a lower rate, another 50 basis or even more, they're going to be disappointed, because I think 2 or 3 years from now, prices are going to be higher than they are now, even with more supply coming into the market. For example, in a lot of suburbs that we track, bidding wars, especially in the New York metro area, are 40 to 50% of the closings. So what does that tell you about supply? It tells you that it's extremely low. It's not the same in every market. Some markets have more supply than others, but it is still a challenge in housing right now, is supply. And the Fed, if you look at what happened this spring, this is a very underwhelming spring market.
Right.
I think consumers were expecting, this is, rates are going to come down and we're going to see this sonic boom of demand. But rates until the last few weeks have really been sort of stuck at an elevated level. And you're not going to see a lot of, you didn't see the surge that everybody was expecting this spring. And now the consumers are, I don't know if anybody's taking the forecast seriously, because it's like we just keep setting the rate cut date 2 or 3 months from now.
Well, if you are one of these people who had been hoping for that 25 basis point cut to be the thing that ignites things, and not just ignites things, but to Lisa's point, makes housing prices going down, asking for a friend, when does that moment come? How long will it take for enough supply to come online that actually you see some relief?
I think it's 3 or more years. I think it's not a couple of quarters. I think it's a long process, because rates were too low for too long during the pandemic, and literally existing inventory was wiped clean off the earth, basically, and we're coming from a very low point, and that's a challenge. And in fact, in this period, new development or new construction, which is only 10% of supply, is where we could see faster supply coming into the market, but that's only 10% of the market. The other 90% is based on organic growth, and it's starting from, a very low point, and that's the challenge.
Can we talk about the rental market in New York? Manhattan prices are actually decreasing. Why?
Yes, actually, Manhattan. So the way to think of pricing in Manhattan on the rental market is it's almost like a choppy. I don't know if you call it a bottom, but it's this. 1 month it's up, 1 month it's down. It's been like this for about 6 or 7 months, but still remaining at very elevated levels. In fact, rents right now are about 20% higher than before the pandemic.
So I guess that when you put all this together, this is actually kind of a counter to what the Fed is saying. They're saying that actually when they cut rates, they're going to be just adjusting things, and that inflation will continue to go down, and that rents are just a lagging indicator, and that they're coming down much faster. From what you're saying, it sounds like that's not the case, and that when they cut rates, they're going to reignite some of the price increases that have kept inflation where it is, given where rents fall in terms of weighting in the inflation metric. Is that true? Is that kind of how you see things?
So that's how I see it. But the sort of the bigger question mark for me is that sort of initial burst in activity of a modest rate cut. How long does that surge or that pent-up demand last? Is this a 6-month phenomenon? Is this a long-term phenomenon? That's the question in my mind. How long will this hold up?
Jonathan Miller, it's always wonderful to see you. Thank you so much for being with us. Pleasure. Jonathan Miller of Miller Samuel, at a time when people around this table are inquiring minds about rents and buying homes.
2 out of 3 are.
2 out of 3 are.
Exactly.
Some people have a locked-in mortgage of about 3%, but whatever. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. North Korea and Russia are deepening their ties. both sides pledging to provide immediate military assistance to one another if one of them is attacked. The pact revives an agreement dating back to the Cold War. It materialized during Russian President Vladimir Putin's first visit to North Korea in nearly a quarter of a century. Manchester United co-owner Jim Ratcliffe says it will take time to rebuild the famed English football club. United finished 8th in this year's Premier League and haven't won since 2013. Ratcliffe told Bloomberg it will take time to return to the top.
We will improve everything, because we want to be, at the top of that. We want to be competing for the Premiership every year and competing for the Champions League every year. That's where we need to be. We need to be where Real Madrid is today, but we're not there at the moment, and it will take time.
And get ready for busy roads and long TSA lines. A record nearly 71 million Americans are expected to travel over the Independence Day holiday. According to AAA, about 60 million of those Americans are expected to drive 50 miles between June 29th and July 7th. That would be an increase of nearly 5% from a year ago. Nearly 6 million are expected to fly during that time. That's up almost 7% from last year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, an uneven cutting cycle for central banks.
So they hold off for a little bit. Same with the Fed. They're not jumping right in like the ECB did. But ultimately, their next up is an ease.
Next. It was supposed to be next a while ago. It might be next, in 3 months. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg.
About 45 minutes till some key U.S. economic data. Jobless claims we haven't talked about that much. We should probably talk about them a little bit more, considering that people are looking at some potential high-frequency data to show a potential turn in the labor market. Equities still up 55.80 on the S&P. If this holds, a 32nd record high in the United States. Euro at 107.28, a little softness. 425 on the 10-year, rounded up 2 basis points. And crude up about 0.1% at a time. We're heading into a really busy driving season. Under surveillance this morning, an uneven cutting cycle for central banks.
So they hold off for a little bit. Same with the Fed. They're not jumping right in like the ECB did. But ultimately, their next up is an ease. But it's more about just really what's an organic recovery happening in Europe. We've got obviously some political noise and Macron calling a presidential or calling for an election was not on my bingo card. But in general, I think the macro fundamentals went out, and we're still positive on Europe here.
Here's the latest. The Bank of England holding rates steady following the Swiss National Bank's decision to cut borrowing costs for the second straight meeting. They follow the ECB's rate cut earlier this month, investors weighing the U.S. and UK elections and political turmoil in France when charting the global central bank cutting cycle. Put it all together. Go figure. And Terry Wiseman is going to do that for us. He is of Macquarie, writing this. The proposals of France's left-wing and right-wing coalitions both diverge sharply from pro-market principles and fiscal responsibility and could undermine France's relations with the EU. Euro-dollar may settle near 105 and linger there. Terry joining us now. Terry, great to get your thoughts on this, especially because we had two European bulls on just earlier in this show. You're going to take the other side. Do you think that this political noise is more than noise and actually could have a protracted weakening kind of impulse, at least through the currency channels? Why?
This is not a story about growth. This is really a story about investor confidence, especially in the sovereign risk ratings of some of these countries that have for a long time had very high debt ratios and have been unable to get their deficits under control. And we have seen in the past episodes where the market gets concerned about sovereign credit risk issues in Europe, and you also see the euro decline in those instances. Now, the case that we're facing now is very interesting because it's a major power, in the case of France, that is now at the center of these concerns. And I have to say that I have read a lot of analysis suggesting that if the National Rally wins this election and effectively takes control of domestic policy in France, that it won't be so bad because there'll be market discipline. But let's keep in mind that the starting point is not a good one, right? You have France running a 5.5% of GDP deficit. Their debt ratio is about 110%, and the National Rally, even if you take the most conservative estimates of how much they want to spend, is going to add to the deficit, not reduce it. So the trajectory is not going the right way, and that's the concern I have.
So this is a relative game, and we're all relatively terrible when it comes to deficits. So why is one worse than the other, considering what the U.S. is facing, what the rest of the world is facing?
No, it's a fantastic point. The U.S. has a very high debt to GDP ratio. We've seen a lot of emerging markets raise a lot of debt during the pandemic. They're stuck with that debt now. They're facing very high debt to GDP ratios. I would say if the problem is different in Europe, it's because, first of all, the euro is not the world's reserve currency. Certainly, it is a reserve currency, but not the reserve currency. And for that reason, you can make a case that as long as there's something that's a little safer and is treated more favorably by official reserve allocators, the dollar will still be the place to go if there's a problem with the euro or the sovereign debt in the euro area. The other reason, of course, is that France is a country in a union. It's facing Brussels and it's facing the ECB. It is not really at liberty to do whatever it wants, but if it tries, it risks disruption of the political union. We don't really have that situation here. So I would say those are two major points that are different with regard to Europe and the U.S.
And hasn't Giorgia Meloni kind of reframed this debate? She was a Eurosceptic that now the headlines across Europe is that she's the queen maker in Brussels. Hasn't she set off a new path almost for the right wing?
Absolutely, and I'm not saying that the National Rally in France will want to leave the euro area. We're not talking about Frexit either in France. I mean, they have had a change of heart over the last few years too. I think they've noticed that this is not really the most popular tack to take if you're trying to gain power in any of these European countries. And at the same time, they are going to go on a path that is in contravention potentially to the Stability and Growth Pact of the euro area, and this is where the concern lies. So you can be pro-euro and still try to press Brussels to meet your demands as opposed to you meeting Brussels' demands.
So what is your base case going into this snap election?
In France?
Yes.
There's two elections going on, of course. No, I do think that the National Rally will be able to cobble together a coalition. It's certainly not out of the question. If that happens, then they will be able effectively to appoint a prime minister. The President, Emmanuel Macron, has no choice effectively but to agree to that. And then you'll see domestic policy potentially shift in the direction that I've discussed, i.e. towards more spending, towards some tax cuts. It'll be a decidedly non-market friendly government. We might see tariffs, more tariffs put in place for goods coming in from outside the EU. Certainly France would press Brussels for that. I think that's what we're facing. Not a market friendly situation, but also a modicum of irresponsibility when it comes to fiscal management.
A lot of what you're describing, though, were known knowns. We knew that that would be the stance of Le Pen and her party. We knew that for the European parliamentary election that the right wing would gain a lot of seats. We knew for Mexico who would likely be elected. We knew in India likely how the election would happen. Yet it is a market that continues to react in a big way to all of these things.
Yeah, I would push back a little on the idea that we knew what was going to happen with the European parliamentary elections. Now, granted, I was discussing this in May, and I had flagged it as a risk, and it was one reason why I said, despite the fact that the euro was rallying up into the 108 space, we should avoid it because we still face this risk in the European parliamentary election. And we had flagged specifically the prospect that we could see a change of government in France in the National Assembly with a new prime minister who's not of the same party or not of the same ilk as the president. So it was not too much of a surprise to me. I can understand why it was a surprise to the market, though, because the market tends to ignore political changes and turnabouts until it's staring them in the face. In the case of Mexico, the prospect that we were going to get a super majority in Congress was not anticipated neither by me nor the markets, and I think that was a bit of a surprise.
Okay, can I throw another one at you then?
Sure.
In the UK, the polls are all that we're going to have this Labour wipeout, that they'll have over 500 seats. Conservatives get something like 53 seats. The Labour has been talking about things like a double the carry tax. There are a party who perhaps will end up spending more. Are we prepared for this? Again, something that we know is going to be a wipeout.
Hard to say. A lot of these left-wing parties, and on the extremes, I should say, not just left-wing but right-wing, have been somewhat averse to detailing their policy agenda once they take power. And there's a reason for that. They don't want to alienate voters, certainly not the centrists ahead of elections. But I would tell you, with regard to the UK, that might not be the most important issue. Things like deficits and taxes and spending might be the most important issues in France. In the UK, the most important issue, if Labour wins, may be putting a line under the Brexit project. And maybe over the course of a generation, or maybe even half a generation, the UK finally reintegrates. Of course, for that to happen, Labour has to hold on to power. They're the pro-Europe party in the UK. And for that reason, that might be more important from an optimistic perspective, the way the market sees it, than whatever they might do with regard to tax policy and spending policy in the UK.
Is this fun?
No. No, it's grueling because politics is not something that economists are particularly well trained to analyze. Obviously, there are plenty of economists who've applied economic methods to trying to ascertain and predict political scenes. It has not always worked out very well. And look, it's not just Mexico and the UK and France. We saw a surprise in India. We saw a near miss in South Africa. The only thing that's not a surprise is that this year was going to be a highly politically charged year because of the number of elections. But the direction they've taken has come as a surprise to many people, and that is very frustrating.
Well, let's have fun. It sounds like it's going to be a good year. Terry Weissman of Macquarie, thank you so much. You're not alone. A lot of people are echoing that and basically talking about range-bound markets and this difficulty of basically, to quote Lori Calvasina, yet again, staring into the sun. Coming up, Anastasia Amoroso of iCapital, Mandeep Singh of Bloomberg Intelligence, Seth Carpenter of Morgan Stanley, and Savi Sith of Raymond James at a time when everybody is watching the freight train that is NVIDIA. Can it blind us all to all of the uncertainty that lies beneath the surface? This is Bloomberg.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today If I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
What the market wants to see is that the economy is coming back into balance.
The economy is moderating, but very slowly, and I think that'll be music to the Fed's ears.
There is a risk that the economy actually worsens more because of the self-reflective interdependence between the Fed and financial markets.
Higher for longer earnings allows markets to stay here, even though we're going to get higher for longer rates.
There's going to be a real kind of push and pull in stocks, I think, over the next few months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
NVIDIA shares are up another 3.2% in pre-market trading. What else do you need to know? Welcome back. Good morning. This is Bloomberg Surveillance. Anne-Marie Hordern, Danny Berger, Lisa Abramowitz, John Farrell will be back next week at a time where we could talk all about politics. We could talk all about interest rate policies. But really what everyone is looking at is the fact that NVIDIA shares just keep surging to new record highs as that becomes the biggest company, Danny, in the United States.
I love this idea, Lisa, that you come in with the show and you're like, I don't need to show you the rest of the market. Here's what NVIDIA is doing today. It's some 35% of the index's gains so far this year, and I think that's where it gets uncomfortable, that we're riding just on one stock. Not necessarily that it's not a good equity, that NVIDIA doesn't have a huge earnings power, but can this really continue? It just is uncomfortable.
It also creates this real tension where when does the data matter? When do the politics matter? We are about a half an hour away from initial jobless claims, as well as housing starts and building permits and all of these other sort of macro features that kind of get washed over when it comes to what we see with NVIDIA.
And we'll get stockpiles today to see what's going on in the oil market. Jobless claims I'm interested in because they moved up significantly in the past 2 weeks. But to your point, NVIDIA overshadows everything. And potentially we'll see that once again today.
Which is the reason why we keep watching small caps, this idea of what is the tell from that in terms of a broadening out and an ability to keep going. We've had a number of guests come on the show and say, actually, this is making them a little bit nervous. They want to broaden out. They want to diversify. Our next guest probably is going to say, actually, stop worrying so much because when something's a winner, it's going to keep winning. But Danny, there is this feeling right now, if you don't get that broadening out, does that just actually push people further into this trade?
100%. And I kind of struggle to see how you get that broadening out when you had something like the retail data earlier today. I mean, it's a problem for margins if all of a sudden consumers are starting to pull back. So for the rest of us who don't start with an N and a V in their stock name, how do you really get that earnings power if it feels like we're an inflection point, to use Jan Hatzius's language from Goldman Sachs, if we're in a labor market inflection point, a spending inflection point, where does that juice come from?
And when you talk about an inflection point, we've been waiting for that for quite a while. Emery, when it comes to the labor market rolling over, when we come to inflation rolling over, I was really struck by what Jonathan Miller had to say, that actually just a 25 basis point rate cut would actually reignite demand for the housing market and cause both housing prices and rents to go up. I know you were very interested in that for a whole host of reasons, but that's, kind of underscoring this fear of where is the biggest risk right now for the Fed, for frankly central banks globally.
Well, and we're going to get the housing starts data today. And so many people are waiting on the sidelines, waiting for the Fed to cut. But then the problem he says there is everyone's going to come into the market and potentially there might not be enough supply, but the prices, then at that point, if everyone's coming in, the prices are going to go even higher. So is it almost better to go in now, maybe take, the hit on the rate, but get in? Or you're going to be dealing with a house. And he's saying 2-3 years you'd have to wait on the sideline.
Well, we've got housing starts and housing permits coming up in about 27 minutes. Right now in markets, everyone's just sort of shrugging that off and continuing to buy. You can see stocks, S&P up about 0.4%, 55.80. Again, just to think about where we've come so far this year, a gain of more than 15%. And this would be the 32nd record high of 2024 if it sticks. The euro versus the dollar, 107.16. Terry Wiseman calling for 105. Not a significant weakening, but this idea that the dollar does remain supreme. 10-year yields up just about 3 basis points, losing some of the initial kind of bid that was on the heels of perhaps the dovishly tilted Bank of England 4.25 on the 10-year, and crude up just marginally, up 0.2% as people take a look at some of the shipping delays, but also more demand ahead of a really busy travel weekend. Coming up, Anastasia Amoroso of iCapital as investors eye 5,500 in the S&P. Actually, we already are there. So the question is, what's beyond that? Bloomberg's Bandy keeps saying, as NVIDIA becomes the most valuable public company in the world, and Seth Carpenter of Morgan Stanley with U.S. jobless claims and housing data on deck. We begin with our top story. U.S. stocks looking for fresh all-time highs, powered by, you got it, NVIDIA. Anastasia Amoroso of iCapital saying this: are markets becoming too stretched? The answer is definitely a yes. Near term. And I think it's time for a breather after a monster rally we've had since April 22nd. Anastasia joins us now. So are you bearish, or are you just basically acknowledging that, yeah, things feel pretty heady, and so things could happen?
Look, you have to trade this market. You have to take a week to week. And, if I look at NVIDIA right now, if I look at the NASDAQ, if I look at, for example, the relative strength indicator, it has been screaming overbought for probably the last week or maybe a little bit longer. And when you have this condition, something is inevitably going to happen, and you're going to have some consolidation. You're going to have some pullback. So, yes, I do think the trades like NVIDIA and the NASDAQ near term are overstretched. But that's why I really emphasize, Lisa, the word near term, is because I do think there are fundamental catalysts that are propping up this rally, whether it's in semiconductors or something else. And I don't think those fundamentals are going to dissipate. Near term, too much exuberance for sure.
The problem with this idea that fundamentals are good, sure, but how do you price out the kind of gains that we're seeing? How do you price in $1.5 trillion of market cap gains in less than a year for a company with a business model that, yes, seems to be hinged to the future, but that is not necessarily tested in terms of longevity?
Right, but you can see it in the data. You can see it in the numbers. You can see it in the spending intentions, for example, from hyperscalers and also other companies and other governments trying to build out artificial intelligence. I don't think it's a coincidence that the stock has rallied as much as it did when you have, I think in the last quarter, you have a 427 year-over-year increase in data center spending on NVIDIA chips. So that's what I mean by fundamentals. And I don't think that's a one-off, obviously. I don't think it's a couple of quarters, but it might still be into 2025 that we see this surge in spending on artificial intelligence. Because let's face it, this is the biggest megatrend that we have today, and you either going to implement artificial intelligence or you're going to be left behind. And that's why everybody from a hyperscaler to, I think, a smaller fintech company, to probably a logistics producer, all of those companies are figuring out how to embed AI. And you can't do that without those core chips.
Even though some of the fundamentals are there, if I wanted to build a really successful trading strategy this year, what kind of would have been simple? I'd get all of my best quant friends together, which, you know, I have many, not really, you know, and put together an equity momentum strategy. In fact, that strategy's done so well, market neutral momentum, that it's the best year from it for 2007. So it's clear that a lot of algos are riding this wave. I'm worried about the bots. Should I be?
Well, if the trend is your friend, you know, you shouldn't be, right? But the question is, you know, what's going to derail this at the very moment? And actually, this is something that we're thinking about as we ponder the second half of the year. What are the risks? You know, one of the risks is that maybe growth is too weak. The other one is growth is too strong. You know, the third one is maybe NVIDIA or artificial intelligence doesn't deliver nearer term. So I think, and of course, there's politics. There's the elections in France and the United States. So if any of those things present a hiccup, then I think that's when you worry about the unwinds of those trends. But I think the comfort level in the market right now is that those are periphery risks, but we are, and we've been talking about this, we're in the sweet spot right now because, you know, if growth is strong, that's great for all sorts of trades. If growth is weak, well, guess what? The Fed is going to step in and actually cut interest rates. So that's why I think so many investors have been sticking with the trades that are working.
Even so, even if growth is strong, you look at what some of the earnings estimates are for next year. We're at 14%, I think, is the latest consensus, which would make it the strongest year for S&P earnings since 2008 if you get rid of some of the COVID weirdness from 2021.
Yeah.
Does that make sense to you, or do we need to reckon with something different if there is a tinge of slowdown in this economy?
Look, this makes sense to me because one of the things I'm encouraged by beyond the artificial intelligence, you know, momentum is that I actually think there's a fair bit of economic momentum globally. You know, for example, it was all about the U.S. consumer really holding up the overall global economy. We still have the U.S. consumer, but we now also have the global economy that's pacing something like 4% growth versus 0.8% that we saw just a few months ago. We also have the global manufacturing momentum that's really picking up in the United States, in China, and Korea, Taiwan, Europe. So that's a whole lot of, to Lisa's point, broadening out that I actually think is playing out beneath the surface.
Based off the retail sales that surprised the downside earlier this week, are you concerned at all about cracks in the U.S. consumer?
You know, it's the story of that bifurcation, unfortunately, that continues to play out. And for example, when we look at the spending intentions and the perception of prices across the consumer cohorts, unfortunately, the lower income consumer is seeing that price pressure and is therefore lowering the spending intentions. You know, so that's one thing, that you don't actually see the same dynamic in the higher income consumer. You know, the other thing that's happening, of course, when you look at credit card default rates, for example, that's the same dichotomy. We're seeing some of the normalization in the lower income cohort and those delinquencies rising, but that's not the case, for example, when you look at American Express and you look at those default rates. And the last thing I would say, look, retail sales are important, but it's not your entire consumption basket. You know, it's what you spend at some of the online shops and brick and mortar and you know, gas stations. But when you think about what especially the high income cohort is going to be spending on, it's entertainment, it's travel. And you're seeing very strong momentum in those parts of the economy.
I also want to ask you about the politics of Europe because you have a call on this. You think now is the time to actually pile in?
I do. We wrote a piece and we called it the Summer of Europe. And, you know, I don't think it's just a summer trade. You know, I think beyond the politics, I'll come back to this in a second, but beyond the politics, I think there's a lot of strong economic momentum that's playing out in Europe. If you think about Europe in the last couple of years, you had a spike in oil, in natural gas prices. You had a spike in mortgage rates because 53% of those mortgage rates are adjustable rate mortgages. So there's a lot of pain that has occurred for the European consumer. But you fast forward to today, and we have one rate cut that's already in place, hopefully more to come. And so I think the peak pain from mortgage rates is now behind us in Europe. And so when I look at the real disposable income and the forecasts that we have for this year and next, they're supposed to pick up relative to where they've been last year. So that's why fundamentally business confidence is recovering in Europe. And I think there's a lot to like from the economics. And then, you know, when you look at prior election cycles, for example, 2017, we did see that volatility picks up into the election. It's likely subsides thereafter. So I think there's enough precedent to say that election volatility should be bought.
Do you think that basically U.S. traveler is going to single-handedly support the European economy? I'm just saying.
Well, Lisa, I don't know about you, but as far as everybody I talk to seems to be heading to Europe this summer,
right?
And obviously, there's data to support that as well.
Yeah. Well, I mean, I'm just wondering how much this is actually going to help. When you put it all together, what you're saying, it seems as though you're not bearish on NVIDIA, but you're not bullish, particularly at this point, in order to sort of see a massive surge. Basically, don't get out, but it might be a little late to get in. And that basically right now the gains are to be had elsewhere. Is that basically the way that you would frame it, that independent of all of the uncertainties of rate cutting cycles and elections, that right now, if you just follow the economics, things aren't that bad. They're not going to get that bad. The broadening out's going to work. And some of the really kind of expensive trades might need to pause for a while.
That's right. I think there's some rebalancing that can be done in the portfolios right now. I don't think you should wholesale get out of the NVIDIA or the NASDAQ trade, but maybe, just maybe, you want to pare back some of those gains that you've had in the positions, and maybe you want to reallocate some of those parts of the market that actually consolidated over the last couple of months and have not participated. And so things that I would be looking to is partially consumer discretionary, consumer finance. I mentioned that some delinquencies are rising, but they're actually pretty well in check and normal. You may want to look at the industrials sector as well, because actually the manufacturing momentum is rising, and manufacturing upswing typically lasts about 9 months. So I'm not saying get it wholesale out of the winners, but peel a little bit back and reallocate to the broadening out trade.
And Anastasia, it also must be time for vacation. Have a great time on your vacation. See you on the other side. Anastasia Immerse of iCapital. Always wonderful to get your thoughts. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. It's been a tense week between Israeli Prime Minister Benjamin Netanyahu and the White House. Netanyahu released a video criticizing the U.S. for withholding deliveries of weapons and ammunition. And in response, the White House reportedly canceled a meeting with Israel scheduled for today, where they were meant to discuss Iran. In a follow-up, the U.S. ambassador to Israel told Netanyahu the weapons are in the process of being delivered to Israel. Dutch Prime Minister Mark Rutte is on the verge of becoming the next NATO chief after the president of Romania dropped his bid. The outgoing Dutch leader now has the support of NATO's 32 members to succeed Secretary General Jens Stoltenberg, whose term is set to expire in October. Allies had hoped to select the next head of the military alliance before a NATO leaders summit in Washington next month. And McDonald's is going all in on the value meal. The burger chain will launch a marketing blitz and a new $5 meal deal next week, aimed at bringing back diners hurt by inflation. The $5 meal includes a McChicken, small fries, 4 chicken nuggets, and a soft drink, and comes as other fast food chains such as Burger King and Starbucks prepare similar promotions. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus Bloomberg's Mandeep Singh with NVIDIA, surging once again. That's next. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning. Welcome back. Another morning of NVIDIA potential gains. Just want to put this in perspective. On Tuesday, the 3.5% increase in NVIDIA added $113 billion to that market cap. So just to give you that perspective, that's equal to most S&P 500 companies in one day. Time now for the morning calls. First up, Williams Trading downgraded Nike to a sell with a street low price target of $75. The analyst saying Nike's loyal customers like the brand but are unwilling to pay full price for most of the product. Next up, KeyBank raising its price target on Meta to $540 from $475. The firm maintaining an overweight rating on the shares, citing progress with AI across engagement and advertiser returns. And finally, Stifel raising its price target on NVIDIA to $165 with a buy rating. The analyst updating guidance after a 10-to-1 stock split and projecting continued growth into 2027. The need to power AI lifting NVIDIA to the world's most valuable public company. Bloomberg's Mandeep Singh joins us now. Mandeep, you look at all of these statistics about how much NVIDIA has gained, whether it's $1.5 trillion of market cap over, 8 months or something or less, whether you look at the fact that 3.5% gains on Tuesday added a McDonald's to their market capitalization. You start looking at all of this and you start wondering, when does it get too far? How do we even measure this?
Well, so I think in the case of AI, what we have seen is the fundamentals for NVIDIA have improved over the course of this year from where we started beginning of the year. That has driven positive revisions. The question that investors are asking right now is, how big does this market get? Because what we keep hearing is the model sizes will get bigger and bigger. GPT-5 will be at least 5x times GPT-4. And so if you have to train a bigger model, you need more chips. And the other aspect of this is, if you have more chips in a cluster, you can train it faster. So that's what's driving the euphoria, is everyone thinks AI obviously is a big deal, but what's driving the kind of the upward revisions is the fact that the models keep getting bigger. And that's where, and your existing model providers will have to spend more. So likes of Google, Microsoft, all the hyperscalers will have to raise their capex. And I want to see how investors react to that in the 2Q earnings, because what we saw in the 1Q earnings when Meta raised their capex, it was a negative reaction.
So just want to throw this stat out there. This is from Thomas Thornton over at Hedge Fund Telemetry, LLC. He pointed out that today's pre-market move is equal to 2025's full-year revenue guidance for NVIDIA of $125 billion. You start taking into effect the sort of revenue implications that the company is putting out there with the implications from the market moves. How many years does NVIDIA have to continue this kind of explosive growth to justify valuations at this point?
I mean, absolutely. At the beginning of the year, they were trading at 25 times PE. Now they're close to 50 times PE, despite the numbers going up. So clearly, a lot of the goodness is priced in, and they have executed to perfection. I mean, all credit to, how well they have executed in terms of quarter after quarter raising their guidance. But I'm surprised by the lack of competition. You would have thought, given the high prices, given the fact that everyone recognizes it's a big market, there should be more competition. And right now, there is no competition in sight. NVIDIA is moving up the stack. Not only are they doing chips, they're doing complete systems. They're doing networking. They're actually doing software as well. So it'll be interesting to see how those revenue streams evolve, because that's what's going to drive the multiple.
Seems like not for lack of trying. I had a conversation a few weeks ago with Apollo co-president Scott Kleinman when they just given Intel this huge JV to fund this chip manufacturing plant in Europe. So the likes of Intel are attempting. Is there anyone? Is it an Intel? Is it a big already established market player? Is it some upstart that somehow is armed with an insane amount of capital that disrupts it? Or are you saying, there's no one there.
No, actually, so you bring up a great point. Like right now, the market is supply constrained because TSMC can only make so many chips. And even though they're expanding the capacity, they can only do at a pace where, it allows their shareholders to fund the CapEx. And there are just constraints around expanding capacity. Once Intel gets to a point where it has the capacity to manufacture GPUs, even if it's not their own, but someone else's, I think that's where you will see some rationalization. We haven't seen that yet because there is no capacity to manufacture those chips. So right now the market is focused on the next 2 to 4 quarters. But if you look far ahead, I believe there should be capacity rationalization.
When it comes to rationalization, and you look at AI and NVIDIA specifically, are they in line with reality of the sense that the Census Bureau come out and said only 5% of US companies are actually even using AI? That's not a lot.
Well, again, it's an early trend, but where it's most visible is hyperscalers are the ones that have gone all in. They spent almost $200 billion in CapEx last year, and all the incremental CapEx went to buying GPUs. So if they can translate that into revenue, we know for Microsoft Azure, it was 7 percentage points of growth. Now that number needs to keep going up, because if it's flatlining, that's a sign that AI isn't translating into revenue. There is a lot of upfront investment, but the place where it's going to show first is the hyperscalers. They are the influencers when it comes to this AI wave.
So what's the timeline of that?
Well, quarter after quarter, you want to see accelerating fundamentals. You don't want to see flatlining because the hyperscalers talk about copilots, workloads being deployed on their clouds. You want to see that number keep going up. And then application revenue will show up, but that's how technology always plays out. First it's the infrastructure, then it's the software. And right now, hyperscalers are in the best position to determine how much of this is getting adopted.
Is anyone bearish on NVIDIA right now? Anyone at all who you talk to?
Well, so again, there is that aspect of, holding NVIDIA in the portfolio because it will make you look good, and it's summertime and end of quarter, so you could argue, there is a lot of window dressing going on, but at the same time, the fundamentals are still strong. So in the end, it comes down to whether the fundamentals keep accelerating or you start to see flatlining. There is a concern around margins because when you look at the next year's revenue, 2025, even though the growth tapers 33%, the margin is flat. So till now, NVIDIA has shown margin expansion. So once margins start to flatline, you have to ask yourself, where is the next catalyst? If it's software, then I think it's great news, but that's what you want to see in the numbers.
Mandeep Singh of Bloomberg, the numbers, do they even matter? At a certain point, Mandeep Singh, we appreciate the insight, and honestly, it does seem like something people need to have in their portfolios. We are just about 5 minutes away from the latest round of economic data in the U.S. Question I have, honestly, for both of you is, what's going to be more important, initial jobless claims or even some of the housing data, especially given what we've heard from Jonathan Miller? Danny, what do you think?
Well, for me personally, probably the housing data. But I think for the economy as a whole, the initial jobless claims is more interesting because we have had this mismatch we've talked a lot about, right? The household survey shows declining jobs, and if non-farm payrolls show gaining jobs. So even though it's very high frequency and very volatile data, it goes some way to trying to solve the mystery.
And they moved up the last 2 weeks. I think that's why I'm so interested to see where they're coming in today. And yes, maybe personally I'm interested in the housing starts, but for the economy going into an election, you saw last night Biden is head-to-head, is winning in this head-to-head poll from Fox News. And some of that had to do with still not great on the economy, but a little bit better. And this sort of data is important.
So that's coming up in just a couple of minutes. Right now in markets, you do see a lift to the S&P 500, just giving you a state of play. Right now, there is about a 65% chance of a September rate cut being priced into the market. So people looking for a softening that is welcoming. Coming up next, Seth Carpenter of Morgan Stanley.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Just moments away from U.S. economic data, in particular initial jobless claims, which, as Anne-Marie pointed out, have been coming in at a more elevated pace. If they continue that, what that says about the potential weakening and the tipping point that we're at right now. S&P futures up about 0.4%. NASDAQ outperforming about 0.5% up. Yields just marginally higher as we prepare for U.S. initial jobless claims, as well as housing starts and building permits all coming in. Michael McKee, Bloomberg Economics and Policy Correspondent, here with us. Mike, what do you see?
I don't have great news. I don't have bad news either on jobless claims. This is sort of comes down in the middle, 238,000 after 242 in the unrounded, unrevised number from last week. So it is down, but it's not down a whole lot. So does it tell us anything? Continuing claims, 1,828,000. That would be a rise of 8,000 if we did not have an updated number here. And we'll get you those as soon as they come through. Well, here we go, 1,813 last week. So it is a significantly higher, not significantly, but it's higher for continuing claims. Jobs claims last week revised up to 243,000. Now let's take a look at the housing industry. Housing starts down 5.5% this month, or in May rather, after 5.7% gain in April. The forecast was for a slight gain for housing starts, and building permits also down 3.8% following a 3% decline last month. So not good news on the housing side, and this just continues questions about what is happening to housing, because at this point what we have is a sort of shortage, crisis shortage building in housing. Not enough housing as housing formations continue to rise. And what the reason is for this drop-off, I'm not really sure, whether it's employees or running out of land, or businesses, construction companies just being cautious.
Michael McKee, stay close. Thank you for that. Right now, the way this is being read in markets is on the margins, giving more of a green light for a Federal Reserve to potentially cut rates. Not a significant move in equity markets, although we're tracing some of the earlier gains on higher than expected initial jobless claims, and really even higher revisions, marginally so, but still a clearly elevated pattern of initial jobless claims. If you believe that 3 makes a trend, you can see the Russell really pull back up now just about 0.1%. In the bond space, you can see yields higher. This is where the real move has become, where all of a sudden yields on the 2-year lower marginally, but still the direction of travel is that on the margins, this gives more of a green light to a Federal Reserve looking for reasons to cut. 4.7%, 10-year yields still staying in around 4.23, and 30-year yields at 4.37. Bleeding this through the foreign exchange channel is sort of a confusing one, and always has been. What you can see is basically ongoing euro weakness as people take a look at the dollar being the haven regardless, 107.28. Honestly, though, this really does raise a question. Are we starting to see a trend? Danny, you pointed to the fact that we have seen elevated jobless claims. Right now, we see 238, that is higher than the expected 235. The revision being at 243,000 from the prior week, up from 242,000 reported.
I think I'm going to eat my hat, because I actually think housing starts is maybe more interesting. The fact that it is so much lower than what we expected, a decline of 3.8% month over month. It was expected to rise because the expectation was there's not a lot of supply. Surely there will be more houses being built. Maybe this is home builders trying to keep some sort of lid on prices by not putting too much supply out there. But it goes to this question that you asked earlier, Lisa, of how will a cut actually impact housing? Will it have the impact that the Fed wants it to do, which is not too big? Does it reawaken animal spirits? This housing market is not playing out as we thought it would.
Mike, final word. Is that odd to you as well?
Well, it's odd that we are not keeping up. Yeah, usually markets clear and they find a reason to do so. Right now, according to the Census Bureau, housing completions are down significantly. They're down 8.4% from April, and that doesn't give you a lot of confidence that things are going to get better. Yesterday, we saw the National Association of Home Builders drop their confidence value down as well. So there's something going on in housing beyond what we have seen in recent months. Whether this trend continues, we don't know. But this is the time of year when, with the weather better, with people looking for housing, you would think that maybe builders would see some more reason for optimism.
Michael McKee, thank you so much for that. Joining us now is Seth Carpenter of Morgan Stanley. We're so pleased to say, Seth, what stands out to you? Initial jobless claims actually having an upward trend, or this idea that housing is flat on its back?
I mean, I think if I take them all together, I'm actually pretty constructive on the U.S. for this year as a whole. However, I think it's clear to me that we're going to see slower growth over 2024 relative to 2023. And so the incremental softening that you all were talking about when you talked about jobless claims and where they were going, you always came back with some sort of adverb to modify how much it was up, sort of slightly, modestly, or whatever. So it's not as though things are falling off of a cliff. I think for the housing sector, it's really important. Supply for single-family homes is clearly constrained because anybody who's got a 2.5% or 3.5% mortgage, they're staying put. And so the supply, as Mike was saying, is constrained. On the other hand, monetary policy has always worked through the housing sector primarily, and I think builders have to be a bit cautious because they got to ask themselves, where is demand going to be? And so what does it mean? I think it just means all cumulatively together, we're getting that modest slowing in the economy. We think things should slow down. We think inflation's coming down as well, and taken together that allows the Fed to cut. But I don't, for now, see any of these data as being harbingers of just doom, of somehow that we're going to go off of a cliff anytime soon.
Well, we can find plenty of people who probably do find it doomsaying, and this sort of question of a tipping point has often been thrown out there. Neil Dutt is saying this is the time to cut rates because if you don't, you never see a linear increase in unemployment. You never see a linear kind of weakening in the jobs picture. What gives you comfort that we're not seeing the precipice of some sort of market increase in unemployment at a time where we are seeing an inflection higher in jobless claims?
Well, we've also never seen an economic recovery from a global pandemic like the one we're living through right now. So as we were coming out of the pandemic, there were lots of frictions, lots of dislocations, lots of things trying to sort out where to be. Businesses were running shorthanded for years at a time. And so now we're seeing them settling into, wow, this is staffing closer to what we're going to want in the long run. And so that kind of readjustment from a truly unprecedented shock, I think we're now starting to move into the more normal stage. So to say that we haven't seen this situation before is true. On the other hand, we haven't seen this situation before, and so drawing massive conclusions about whether or not this sort of pattern is telling us something, I think we want to be super cautious.
Not to ask you to draw a massive conclusion, but can you add just the retail data we got from earlier in the week into this, that there does seem to be some price fatigue, so you have companies who are not as worried about labor shortages, and now their margins are starting to get squeezed.
Absolutely. So we think of this as all going in the same direction. If we look even the full quarter for the first quarter where we have all the data for the quarter, durable goods spending quarter on quarter was negative. Non-durable goods, inflation adjusted, was flat quarter on quarter. So where the residual strength was for the consumer was in services. That's exactly the sort of slowdown that we've been expecting to see. And I think the retail sales data, again, overweight goods sort of shows, you know, the consumer's not dead. The consumer hasn't stopped spending entirely. The consumer hasn't said, that's it for me, I'm checking out. Instead, what they said was, yeah, we've already bought lots of lawn furniture. We've already bought lots of computer screens. We've already bought a home office 3 times over. Maybe it's time to cool down a bit.
Two issues you just brought up there. One is consumers, and they're concerned about higher prices, so they're becoming more discerning, but also what's going on in the labor market. Two issues that you say are the biggest when it comes to U.S. election: tariffs, which many would say inflationary, and also immigration. How are you looking at 2025?
with a lot of trepidation because lots of different things could happen. I agree with you. When clients ask us questions about the elections, immigration and tariffs are two really important things. I would say to the earlier conversation about have we ever seen a situation where the unemployment rate drifts up gently over time, it's not very common. On the other hand, neither is the kind of increase in the labor force that we're seeing from immigration. That's not very common either. And so in lots of ways, the gentle rise in the unemployment rate that we've seen, 4% unemployment, I'm old enough to remember when 4% was considered pretty good. So we did see a rise on net, but a big chunk of that has been coming, at least over the past year, from increases in supply. And I think immigration matters there. And so with the election, we put out a piece of research for our clients over the past week or so, and you could see a range of outcomes of what happens to the labor force depending on policies that get put in place. And there, I just think the range of outcomes from the election is vast, and we have to be super humble about what's going to happen. You could see big constriction in the labor supply, which would be adverse for growth and could be inflationary, or you could see things sort of status quo, a little bit of a reduction, in which case the economy gets to trundle on.
We have to be humble, or the Fed has to be humble? How do they think about these kind of potential massive changes while they're deciding whether or not they're going to make a cut before the year end?
So I think humility is called for all around, particularly for anyone in economics where we're not particularly good at it on average. So we need to practice humility a lot. For the Fed, they're going to have to sit back and wait on the policies. I do think if we listen to Jay Powell, if we listen to sort of where our analysis is that monetary policy is currently restrictive, they can come off of the peak now this year and not have to worry about having done too much in terms of easing policy. I think as we get into 2025, though, they probably do need to think a lot more about what the election outcomes mean for policy, fiscal policy, tariff policy, all other policy, immigration policy, before they can have any sort of conviction about which way they need to go with policy.
I asked Terry Wiseman, is this fun? And he just said no. Is this fun for you?
This is, I have to say, one of the most challenging macroeconomic environments to do forecasting in, and it's a double-edged sword because on the one hand, very hard to do forecasting when there are so many cross currents and so many situations that you haven't seen before. On the other hand, maybe it's a good time to be a forecaster because nobody else knows what's going on either.
Well, the reason why I ask this is just simply because when I try to put together even the themes to really hook into, I'm not sure which takes preeminence. I'm not sure if it's the rate cutting cycle. I'm not sure if it's the weakening, or I'm not sure if it's some of the disruptions that are causing inflationary increases. I don't have a sense of where the balance of risks are. Is it that if you cut rates, you have a resurgence in inflation, or is it if you don't cut soon enough, you fall off a cliff into recession? I could make a good argument for any of these, and I believe it. So how do you sort of plan with any kind of long-term forecast when the likes of Mohamed El-Ariary is saying, if you don't have that type of long-term forecast, you're going to have a mistake and you're going to have just volatile markets that are going to essentially break?
So I think that's fair. Lots of volatility in the real side of the economy and in markets. I do think the time horizon matters a lot. So some of our clients are very short-term focused, and they're, say, for the rest of this year, I feel pretty constructive. I don't see a scenario where the U.S. really falls off of the cliff over the course of 2024. I do see inflation coming down over the rest of this year pretty substantially, and with that, I do see the Fed cutting. Getting beyond that to the medium-term outlook, I think the uncertainty absolutely goes up. I think the elections are a huge component to which way things go. And I think it is impossible to have high conviction. So the best thing investors can do, the best thing policymakers can do is to think about all of the outcomes contingently and to try to come up with your best set of scenarios. And then you will end up in one of those scenarios over time, but you really have to do a lot of advanced planning. This is one of the reasons why when we talk to our clients, we try to say, we're not going to tell you. We're not going to predict what's going to happen with the election. That's a mug's game. However, if we think across the different plausible scenarios, here are what the key outcomes would be for fiscal, for tariffs, for immigration, and then here's how you should try to think about planning for that.
Just to add to this, because this idea, it's been a criticism of the Fed that they're not being more clear in their outlooks. They keep saying we're waiting for more data, and there are people been clamoring who say, no, give us something concrete, give us a clear direction. But what you and Lisa were just describing is one where there is not a clear direction. So how would you rate Fed communication in this environment? Should they be giving us scenario analysis? Should they be giving us more clear forecasts? Or is it right just to say, look, we need more data, we don't know right now?
Yeah, I think especially the way you framed it, when some of the FOMC members sort of asked me questions about how they're doing, I actually think under these circumstances, they're doing a pretty good job. The quip I like to give them is be as clear as you can be, but by all means be no more clear than that. And I think they would be doing themselves a disservice, they'd be doing markets a disservice if they tried to be precise at a time when you can't be precise. And I think that would be false precision, I think it would be false confidence. And so when the world turns out different than expected and they have to change course, which is exactly what they should do, everyone will complain, oh my gosh, you told us you were going to do one thing and now you're doing something else.
So just buy NVIDIA. Seth Carpenter, Morgan Stanley, thank you. I think this is probably part of the reason why people just look at this soup and they're just like, look, we can bank on this. So let's go for it. All right, right now, let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The British Navy said a Greek-owned coal ship was completely destroyed by an unmanned vessel in the Red Sea. It's the latest indicator that Houthi militants are showing no signs of slowing their attacks. The incident marking the first time a ship was successfully hit by what the military calls an uncrewed surface vessel packed with explosives. The attack sent insurance costs surging nearly double their prior rates, according to sources in the market. Look out, finance. AI is coming for your job. In a new report, Citi saying artificial intelligence is likely to displace more jobs across the banking industry than any other sector. It says more than half of jobs in banking have a high potential to be automated. But even if AI does replace some roles, Citi says the technology still might not lead to a drop in headcount. And sticking with AI, NVIDIA shares are rising yet again, heading towards the opening bell. The latest rally coming after Michael Dell posted on X that his company is building an AI factory with NVIDIA to power Elon Musk's AI supercomputer. NVIDIA surge extends its lead as the world's most valuable company. Shares have rallied more than 170% this year, adding around $2 trillion in market cap. That's your Bloomberg Brief. Lisa?
Thank you so much for this morning and for everything, Yahira. And, you know, what's $2 trillion between friends? Up next, setting you up for the day ahead, and Savi Sith of Raymond James. You're watching Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
about 45 minutes to the opening bell. We can take a look at what's going on in markets. It is positive, although off the earlier highs. This is notable to me. S&P futures now up 0.2%, still well over 5,500, but on the heels of initial jobless claims coming in higher than expected, the wrong kind of upside surprise. Euro dollar 107.21. 10-year Treasury yields, this is interesting, up 0.4%, 4.26%, sort of moving in the opposite direction of 2-year yields, and crude up about 0.3%. Here is the trading diary for the rest of the week. The Fed's Neil Kashkari speaking this morning, plus we'll hear from Fed Presidents Tom Barkin and Mary Daly of the San Francisco Fed later today. Tomorrow we have S&P Global PMI data, which at one point moved the needle quite significantly at a time where people are wondering whether everyone can keep spending. They can keep spending on summer travel. That has been sort of the theme that we keep hearing about. We are looking ahead to that with the Delta annual shareholders meeting underway. Savi Saith of Raymond James joining us now. Savi, what are you expecting to hear from some of these investment meetings, the latest being from Delta at a time where it seems like there is an ongoing divergence between people going cross-Atlantic versus domestic?
Yeah, even in the domestic market, things are really strong. There's good demand. There's a little bit of oversupply, and I think that's the difference between the Atlantic and the domestic markets. Is we're still kind of getting back to 2019 levels in the transatlantic market, whereas capacity in the domestic market has surpassed that. So demand is really strong, but you're right, there is still strong demand in the Atlantic, despite what we looked at last summer as being maybe pent-up demand.
So from a pricing standpoint, do you think that domestically you can get, cheaper airfares the way you're not going to be able to get going transatlantic this summer?
I do believe so, and I think you're seeing that in the data. We've seen pricing being a little bit softer. You saw airlines in the first quarter really pull back their growth a little bit, but as we got into the second quarter and heading into the summer, you're seeing mid to high single digit growth in the domestic market. And that's kind of creating, especially if you're willing to have flexibility in some of those off-peak days or times, there are some better pricing available out there. But as we're heading into July, we're definitely seeing fares strengthen here.
When you look at the domestic market, who's winning this space? Especially we are seeing cheaper airfares.
Yeah, I mean, I think the consumer wins. There's a lot of kind of optionality out there. The fares are coming in better. You'll hear a lot of the executives say that we're seeing record revenue, and that's true. I think this is probably the highest revenue this industry has seen. The problem is we also are having record costs. You've seen a lot of labor cost increases. Fuel, while stable, which is great news for the industry, it is still higher than what it was in 2019. So there are airlines that are kind of struggling a bit more. I think those airlines exposed to corporate demand, especially large corporate demand, that is starting to see a nice recovery here. I think they'll stand out better heading into the summer season.
Savi, Lisa's been talking about how we're expecting a record travel season, especially around 4th of July. And the ability of airlines, whether they're ready for it, whether they have enough updated planes and what the airports will look like. Can you just contextualize the chaos that all of us should expect if we're planning to travel this summer?
Always be ready. The thing with summer is you have these thunderstorms that just pop up from nowhere. In kind of winter storms, you can see it coming, you can prepare for it, and that's the issue. Air traffic control centers, especially in the Northeast and a little bit Florida, are still understaffed. And so the risk of disruption is greater when there are events. And summer means there are going to be storms somewhere. And so just kind of be flexible. But I think airlines have done a lot to help address that. You've seen, some airlines just change the way they build their network. Some airlines just taking advantage of what the FAA has allowed them to do and kind of bring down capacity in the Northeast to make sure that there's reliability. So I do expect this to be a better summer than we've seen for a couple of years, but it all depends on the weather. So I would say kind of be prepared and flexible.
You're giving me like a little bit of confidence, so I feel better about this. Sophie, how about this? Spirit, United, and JetBlue all delaying their analyst days. What's going on?
They all delayed it for very different reasons. So United, they had that FAA review and they just didn't feel like that was the right time to do it. If you look at Spirit, it sounds like they're trying to come up with a standalone business plan, and there are some initiatives they're trying to roll out, and maybe that's taking longer. Maybe they think that the bondholder discussion. But generally, look, there's just a lot of uncertainty, whether you look at supply chain, whether you're looking at the economy. And I think airlines are feeling much more comfortable to do their investor days towards the end of the year, where they'll have better clarity on 2025. Even when it comes to what kind of aircraft deliveries that they can expect, it's better to provide that towards the end of the year than doing it closer to the summer.
Savi Saith of Raymond James, thank you so much for being with us. I do want to bring you some breaking news that car dealers are again idle after yet another cyber attack. This was something that transpired over the past 24 hours. For the first time, the cyber attack is at CDK Global, which is the software provider. Just sort of speaks to this question of if you want to go buy a car, it might be kind of tough to do so, considering that the dealer systems are not available and some of the transactions are having to be done by paper, things of the past.
Well, what's so concerning as well is that car dealers really start to sell a lot more cars during these holiday season. And we're coming up on the long July 4th weekend. There's usually some ticket price sales that could be had. And now you don't have the system to operate on. And they said they don't have a timeline for when this could be fixed.
We'll update you as we get more news. Just taking a sort of a big picture of sort of the day ahead, what I'm looking at is this idea that maybe rate cuts are deferred. We continue to see that, even though they still have to be on the table. This sort of unprecedented moment where we could see a softening now and then sort of the black box that is next year. Denny, what's your big takeaway, given the fact that it seems like the confusion around the macro is just leading everyone to focus on what they do know, which is NVIDIA. And it goes up.
Yeah, death taxes NVIDIA. You know, for the rest of the markets, for these bond markets, I'm surprised at just how sensitive they are. I mean, you talked about this, yields higher despite the fact we had some softer data. And I wonder if that's looking at the housing starts and being like, oh, less housing, supply is lower, prices are up, inflation goes higher. I mean, come on, this is not, you know, a star data set. It's housing starts. And the fact that we're selling bonds on that just shows you how finicky this market is right now.
Or data obsessed they are, because they think the Fed is data obsessed. When you talk about a black box of next year, I was really struck by Professor Pierre Yared, and he's talking about things that are going to make inflation much worse. Fiscal pressures, which we saw in the CBO this week, deglobalization, and rising long-run real interest rates. And you have to think about what Adam Posen said to us a month ago. The Fed needs to start thinking about hiking in 2025.
Well, in 2025, it is a complete unknown. We will probably get all sorts of projections. The scenario analysis really is what stands out to me at a time where you have to have plans for a lot of different outcomes. Coming up tomorrow, Mark Giannoni of Barclays, Katie Kaminsky of Alpha Simplex, Amy Wu Silverman of RBC, and Citigroup's Veronica Clark. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The top names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, Well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From New York City, for our viewers worldwide, I'm Katie Greifeld. It's the first day of summer and stock futures broadly higher. The countdown to the open starts right now. Coming up, futures trading near record highs driven by fresh gains in the tech sector. The S&P shocks again with a cut, adding to the optimism, and Treasuries on the brink of breaking even after a roller coaster first half. We begin with the big issue, AI optimism continuing to push the markets higher and higher.
You have to trade this market. You have to take it week to week. And, you know, if I look at NVIDIA right now, if I look at the NASDAQ, if I look at, for example, the relative strength indicator, it has been screaming overbought for probably the last week or maybe a little bit longer. And when you have this condition, you know, something is inevitably going to happen and you're going to have some consolidation. You're going to have some pullback. So, yes, I do think the trades like NVIDIA and the NASDAQ near term are overstretched.
Joining us now is Samir Samana. He is Senior Global Market Strategist over at Wells Fargo. And Samir, I'm so excited to talk to you today because you're a little bit of a contrarian when it comes to the tech sector and that you think you should be looking at a neutral weighting when it comes to that behemoth right now.
Yeah, hey, Katie. You know, we had it as a favorably rated sector for a long time. We took it to neutral last year. Since then, the sector as a whole, you know, has outperformed, but I think that full weighting probably has helped people participate. We continue to favor large cap equities over smaller cap equities. We think that's probably been kind of the better trade, probably the more easy one for investors to implement. And then we like energy, materials, industrials, and healthcare. We think going forward, if the economy kind of, you know, broadens out a little bit, we think those areas will do a little bit better probably than those concentrated tech names.
Well, a lot of hearts have been broken waiting for that broadening out. And let's talk a little bit about human psychology here, because even with a neutral weighting to the tech sector, you're missing out on pretty substantial gains. So at what point does FOMO really kick in, even though you have all of the arguments in place for that broadening out?
Yeah, I mean, you know, Mandeep Singh talked a little bit earlier about kind of that FOMO and those, you know, money managers that maybe have to own NVIDIA in order to show it kind of within their holdings. I guess from our standpoint, the fact that we have kind of had that large cap tilt really means that investors have kind of gotten to have their cake and eat it too, or at least as close to it as it gets. And, you know, that larger cap, you know, allocation has really kind of been, you know, a saving grace for, I think, most investors this year, because I think those are the companies that most of us recognize. And then having kind of that fade towards smaller caps, towards emerging market equities, you know, really that's where we've kind of picked up our alpha, is in that relative pairing.
Well, we're going to get to large versus small, the size discussion, but when it comes out to other sectors, to really that love being spread to maybe some of those overlooked sectors in the stock market right now, what is going to be the catalyst? Is that going to come from the Fed and the economy, or is that going to come from earnings?
Sure. So it'll probably come from all of the above. So probably the biggest thing going on right now is China does seem to be putting in kind of a bottom with respect to policy. They seem to be taking the left tail risk out of the equation. With respect to Europe, it did seem like we were going to get some economic improvement. Now we'll see what happens in France. And then, yeah, we do think the Fed eventually does cut, and, probably not a bad idea to expect sometime probably around September, especially if the data kind of cooperates. And that probably takes some of the pressure off the dollar. And so that allows some of these more cyclical areas, some of these more internationally oriented areas, probably to do a lot better.
All right, well, Samir, hang tight for just a minute. Let's talk about the economy a little bit in more detail, because the latest jobless claims and housing data out in the last 30 minutes. So let's get to Michael McKee, Bloomberg Chief Economics and Policy Correspondent. What did we learn?
We didn't learn a whole lot about the job market, because the jobless claims numbers, people were thinking that we would get something definitive. We didn't really. 238,000 after a revised 243 last week. So it's down, but not down a lot. The pattern last year was that jobless claims peaked in the same week last year and then started down again. So is this the start of a trend? Too soon to tell. But we can look at the continuing claims numbers still going up. Not particularly good news there, taking longer for people to find jobs. Now, the other big news of the day, the housing starts numbers, quite disappointing. In April, up 4.1%. In May, down 5.5%. That was not expected. Building permits also down by 3.8%. And yesterday, while we were all at the beach, the National Association of Home Builders reported their confidence number fell during the month. And this is not helping the U.S. at all, because if you take a look at what's happening, household formation continues to rise. Nobody's moving on the existing home side. We need more new homes, and we're not getting them. You can see starts dropping off, and housing completions, the yellow line, just really falling off. Where are the houses when we need them? That's a policy problem for all levels of government, and something that's going to become a bigger and bigger issue, Katie. We can also mention that the Philadelphia Fed business outlook is still positive, but fell from 4.5 to 1.3, and prices paid went up a little bit. Not sure what that tells us, but it is out there as a little more data. We have a lot of Fed speak today. Neil Kashkari first on the docket, and he says that it's going to take a couple more years to get down to 2%.
And just really quickly to meditate a little bit longer on the housing market, it sounds like what you're saying is that demand, it's still there, it's still growing, and supply isn't getting a lot better either, so higher prices?
Exactly, and Seth Carpenter of UBS and I were talking about this earlier, and he said, the government's going the wrong way. They're going to attack the demand portion, and it's the supply portion that's the problem. So what do? I think Samir was right, because it's exactly what Lisa Abrams said, or Abramowitz said earlier today. She said, in this situation, buy NVIDIA.
Buy NVIDIA, Michael McKee.
Can't do anything else.
Well, let's bring that question back to Samir Samana, of course, of Wells Fargo, is still with us. And I mean, you think about supply and demand both in the economy, in the housing market, but also when it comes to places such as NVIDIA, still the demand for these chips is so high, and the supply hasn't necessarily gotten to a place to meet that. I know that, of course, you're neutral on tech, but how high is your conviction there? What would you need to see to really bump that allocation back to overweight?
I think probably the easiest way to do it is just to have a little bit of doubt creep in. If you think about, just expectations, as you mentioned, they are just so high. I mean, just the fact that, individual names like that have gone up 50, 60% in a very short period of time tells me that expectations are going up alongside them. The fact that earnings are growing, but multiples are growing even faster, that tells me that you're kind of seeing this gap now between reality and, I guess, hope or expectations. All those things kind of worry me a little bit, especially for kind of intermediate to long-term investors who are looking a little bit further out. I think for them, some of those more, kind of secular, longer-term plays like energy, like industrials, like materials, which underpin the build-out of AI, right? Through data centers, through that additional power demand. To me, I think that's where the AI trade kind of goes next. And I think that's the way for kind of savvy investors to maybe get there a little bit before the market does. Kind of the most recent example of that would be utilities, which, went on a tear after technology did, because again, people were looking for the next trade. So I guess in some ways, that's what I want to do, is find the next place to be.
That's really interesting. A few interesting points there. First of all, it sounds like what you're saying is basically that the fundamentals don't justify the valuations that we're seeing on some of these chip stocks. And in terms of following the AI narrative, finding what's next, it sounds like you're looking for some of those non-obvious bets there.
Yeah, I mean, again, I come back to power generation and data center seems to be two of the clearest winners. It doesn't matter, who's making the chips. It doesn't matter where those chips are being made. It all looks like, when you look at kind of the power consumption of a Google search versus the power consumption of a ChatGPT-4 search, which we're not even talking about 4.0 or 5 yet. You're talking about 20, 30, maybe even 50 times the power consumption. And, Mandy was talking earlier about how the next large language models will be 5x the ones we have currently. So, the power generation might even be more exponential than that. So all of that tells me we're going to need a lot of power. So I want to know what companies are going to provide that power.
How long of a time frame do you have to have there, though? Because I've spoken to many investors about that sort of data center play, that utilities play, and the answer that I keep getting is, yes, it makes sense, but maybe it's a little over-egged right now. You need to have a long horizon to sort of play in that sandbox. What's your view?
So I'll give you one example. When you look at the energy sector and you look at the fact that it still trades at about 12 times, has the highest dividend yield in the S&P at 3+%, that does not look like a sector to me where you have to wait for the payoff, right? You've basically got an 8% earnings yield and a 3% dividend yield. So you've got an all-in yield of just 11%, and that's not accounting for any earnings growth or any multiple expansion. So, I mean, to me, that's kind of the best of all worlds.
And let's talk a little bit about the bond market, because you have another sort of out of consensus view here, and that's that you should avoid adding CDs here. I keep hearing that you have 5% on the short end. What's the point of going out the curve, going long duration, when you could get paid to wait? And it sounds like you're taking the other side of that.
Yeah, so, at least in the short run, what you're going to see is rates kind of flatline for a little bit, maybe even have a little bit of a tilt higher on the longer end. And if you do get that back up on the longer end, what we want to do is we want to try and reduce duration, especially when you don't have to give up a lot of yield. So if the short end is, let's say, 5%, if you can get closer to 4.75 on 10s, maybe 5 on 30s, what we want to do is extend that duration, because, again, we think it's a great time to lock in those yields, even if they don't come down right away. What we do know is if something does, kind of hit the skids from an economic standpoint, that those short-term yields will melt very precipitously, because the Fed will cut very aggressively. Now, again, that's not our base case, but if there is a skew to our forecast, it is that things get worse, not better.
Things get worse, not better. That's pretty much what bond investors love to hear. So let's bring this conversation, especially about yields, to the corporate credit market, because you take a look at spreads, they're very, very tight, but then you take a look at yields and they're much higher than they have been for many, many years at this point. If you're investing in corporate debt right now, are you paying more attention to spread, or are you paying more attention to those yield levels?
I would say it's probably a little bit of both. So what we would say is more traditional areas of fixed income, like treasuries, like corporates, are probably okay to kind of, get that income component. We are unfavorable on high yield. Again, with the spread so tight, you're just not getting the added compensation to jump from investment grade to high yield. If anything, we'd rather take that risk probably more on the equity side, whereas you've been talking, you've got tech and a lot of these other companies where there's so much growth, you can actually access some of that growth on the equity side as opposed to high yield, which is more static.
All right, Samir, always great to speak with you. Hope to do it again soon. Our thanks to Samir Samana of Wells Fargo. And joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle.
Well, Katie, you guys were just talking about NVIDIA. Let's take a look at the world's most valuable company, because it is up once again in the pre-market. This AI play really huge, up 3.2%, really taking the reins from Microsoft and Apple, at least right now. Making it really extraordinary is the fact that around this time last year, it was at less than $1 trillion. So a parabolic move higher on this big move around AI. Speaking of AI, let's take a look at both Dell and Supermicro. CEO of Dell, Michael Dell, yesterday on X said that they are building Dell AI factory for Elon Musk, a startup XAI, alongside NVIDIA. So you can see that Dell is trading higher, and then Elon Musk came out saying that Supermicro computer would be involved as well. So lots of AI play continuing, and let's just keep it going right to Accenture, because they actually missed the consulting, the professional services firm, but up 8.3%. As you can see, the stock is jumping on bookings, and not to mention, not too surprisingly, growth in AI.
All right, Abigail, thank you so much. Now coming up, the Swiss National Bank surprises with a second straight rate cut.
The main instrument that we have is our S&P policy rate. But we clearly said that we are ready to use interventions in both directions if necessary in order to maintain appropriate monetary conditions.
More on the central bank next. This is Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We have a relatively balanced situation. The inflation forecast is going slightly down over time, but not dramatically. We have also a situation where growth is at 1%, hopefully will improve to 1.5% next year. So this is a relatively balanced, modest growth situation, but not that we are here in a expansionary situation.
And that was Swiss National Bank President Thomas Jordan speaking earlier this morning. And Jordan surprising many economists after the central bank voted to cut rates for a second straight meeting. Joining us now from Zurich is Bloomberg's Zoe Schneeweiss. And Zoe, put this into context. Just how surprising was this move?
So most economists did expect the S&P to hold today. Markets were a bit more optimistic on a cut, but still a cut was by no ways fully priced in. That's because inflation in Switzerland, while it's clearly below 2%, and just as a reminder, the Swiss Central Bank has a range for inflation. It has to be between 0 and 2. It's at 1.4, and it's been at 1.4 now for most of this year, and that's just one of those where you think, okay, actually, if inflation isn't going down, why cut? So that was the reason why people were thinking a hold. But what they weren't quite counting on was how concerned the S&P potentially is about the strong franc, and that's one of those reasons why they did cut today.
That's so interesting. Talk to us a little bit more about the franc's influence here, because we've seen this dynamic play out before.
Yes, it's quite reminiscent. We all very much remember January 2015 when they still had a cap on the franc and then actually got rid of that, and that one completely shook markets. Today, it didn't shake markets across all asset classes as it did in 2015, but it did have an impact. So the situation is here that the franc is very popular in times of crisis. The franc is one of those saving currencies that people think the franc always kind of will hold up, so if there's trouble, let's go there. So now the snap elections that were called in France have generally created a lot of uncertainty in Europe. So if there's uncertainty in Europe, you go buy the franc, and that has just driven the franc up to a very high level. The Swiss Central Bank isn't completely unhappy if the franc is strong, because that means that imported inflation that isn't happening. But what they do not want is that the franc gets so strong that then the exporters suffer. And in the case, if the franc gets too strong, what they really would need to do then is do currency interventions to stop that. That, in turn, would bloat their balance sheet. So there's no appetite for that. A much quicker way of getting the franc to stop appreciating is a rate cut, and that's what they did today.
Yeah, the blessing and the curse of having one of the haven currencies out there. Just quickly, we've had 2 straight rate cuts from the S&P. What's next?
So the S&P is generally very good about not giving any forward guidance. What does help you is looking at their inflation forecast. They give quarterly inflation forecasts. And if you look at those, now they've lowered it, and they expect it to be by the end of the forecast horizon at 1%. So that generally would seem like they actually are on quite steady footing. And my bets would be that they would, and Bloomberg Economics also says this, is that they would be a hold in September and then maybe a cut in December. A reminder, the S&P only meets once a quarter, so there's a lot of time for them for things to change. There's also a lot of time for policymakers to think, what should we do next?
All right, Zoe, really appreciate your reporting. Our thanks, of course, to Bloomberg's Zoe Schneeweiss. And of course, as rate cuts are happening in Switzerland, the Bank of England left rates on hold. The central bank left rates unchanged at 5.25% earlier today, but there were some indications that a rate cut could be coming. Joining us now with more is Bloomberg's Lizzie Burden, and it seems like dovish hold is the name of the game here.
You're right, Katie, that was the reaction in markets. Why? Well, they're honing in on this line in the guidance that it was finely balanced for some members of the committee, even though they voted to hold and even though the vote split was exactly the same as last time, 7-2. And you've therefore seen a repricing for the August meeting, so now a 55% chance of a cut in August. And I'm sure there are lots of economists watching and saying, I told you so, because there was this big repricing yesterday off the back of the services inflation reading, unexpectedly hot. And then that's been reversed now. But it's interesting in the guidance today, they actually talked about that services inflation number. Yes, some people thought that it was a risk that there would be second round effects, but others dismissed it because actually this is a backward looking reading and we've been past the peak of services inflation. So the bottom line is August looks live, bar any inflation surprises. But what could, Katie, be a fly in the ointment is today was the last meeting for Deputy Governor Ben Broadbent. He's going to be replaced by Claire Lombardelli, who's thought to be more hawkish, at least, than him. So maybe she's what stands in the way of that August rate cut.
Yeah, so some internal politics at play there, too. Let's talk a little bit more about August, though, because it seems like traders coalescing around that. Like you said, it's not a done deal. And we have a lot of data to get through between now and that August meeting, Lizzie.
Yeah, we do indeed. So that could be the fly in the ointment for not going for August. I think it's interesting as well about this decision that the BOE was very, very keen to say this was nothing to do with the politics. We haven't had any speakers from the Monetary Policy Committee in the run-up to this decision. We've got an election coming, of course, on July the 4th. But if you look back at history, Katie, in 2019 in the election campaign, you had two members of the Monetary Policy Committee pushing for a cut regardless of the politics. And actually, you could look at this and think the vote not to cut today is political. But this is the Bank of England trying to wash its hands of any accusation of being political. And just while we're on the politics, I also think it's interesting that if you look at the polling and if you look at what traders reckon, you're going to have a Starmer government on July the 5th, the opposition Labour leader, and he's going to get the first rate cut. So there are many in the Prime Minister Rishi Sunak's Conservative Party who are going to be tearing their hair out today and wondering why on earth he called an election in July rather than in the autumn.
Yeah, well, it will certainly be fascinating to follow. Bloomberg's Lizzie Burden, thank you so much. Now coming up, the morning calls, and later, Frank Monkham. He is Senior Portfolio Manager over at Antimo. His outlook for commodities in the second half of the year. This is Bloomberg.
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
All right, it's time now for our morning calls. A look at some of the analysts' recommendations on Wall Street this morning. And first up, RBC Capital Markets is cutting its price target on Tesla to $227. The analyst says he's lowering estimates for the company's robo-taxi venture. Of course, Tesla is set to unveil its robo-taxi on August 8th, so mark your calendars. Next up, Benchmark is cutting Spirit AeroSystems to a hold. The analyst cites uncertainty about Boeing's plan to buy the fuselage maker. Spirit, of course, makes airline parts for Boeing, Airbus, and Northrop Grumman, rather. And finally, we have Williams Trading cutting the price target on Nike to a street low, just $75. The analyst says that investors should, quote, sell the stock, and adds that the C-suite of the sportswear company doesn't have the, quote, instinct and experience that the prior team had. So certainly some cutting remarks there. Meanwhile, let's get a check on these markets. Just a couple minutes until that opening bell, you can see S&P 500 futures a little bit higher, 0.2%. We've been hanging out around these record highs. We haven't seen a lot of big moves up to the upside or to the downside, but still grinding higher and higher. You can see it's the same story. If you take a look at the NASDAQ 100, your big tech benchmark, currently higher by about 0.3% as well. Small caps just can't get off the ground and they can't catch a bid. You can see that the Russell 2000, your small cap benchmark, currently lower by about 0.4%. It's certainly been a while since we saw a record high there. Meanwhile, you take a look at the Treasury market. Your 10-year Treasury yield right now, it's a little bit higher, about 6 basis points. Some of that optimism coming out of that market. Coming up, Darden Restaurants getting a boost as profit overshadows Olive Garden's underwhelming sales. We'll discuss next. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood is just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
This is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading. You take a look at the stock market right now. You have the S&P 500 mildly higher, just 0.2%, but it's green. A little bit better if you take a look at big tech, currently up about 0.2%. Small caps, again, like we've been saying, just can't catch a bid. Let's take a look at the cross-asset action right now. You can see Euro USD, that pair just falling just a little bit. We're at 107 on that pair. You take a look at the Treasury market right now. You can see the 10-year yield currently higher by about 6 basis points or so. We're still well below where we were just a couple weeks ago. And meanwhile, you take a look at crude, it's up slightly, about 0.9%. Now, one stock to watch at the open, NVIDIA, of course, the world's most valuable company, extending its lead even further over fellow mega cap tech names. For more, let's go to Bloomberg's Abigail Doolittle.
There are so many different ways that we could take this, but let's start off with this year's rally so far. 181%. We're not even halfway through in the year. That's the craze that we have around AI, but it's well deserved because if we take a look at the numbers, Katie, relative to revenue growth for this year, we are expecting this company to grow by 208% on the top line. These are not small numbers either. Almost $80 billion in revenue. On the bottom line, closer to 700% growth for $1.72. Now, the expectations do slow down in 2026 to 34% on the top line and 33% on the bottom line, but we're nowhere near there. Now, relative to the rally out of the pandemic, up more than up almost 2,400%. And as we do have NVIDIA as the world's most valuable company, something that really, really stands out to me, last January, this company wasn't even $500 billion worth of market cap. Now it's well north of $3 trillion, again, more than both Apple and Microsoft, a parabolic uptrend. When does this party stop? I would argue that at some point, these amazing blowout quarters that they put up, the big outlook guides, at some point when that slows down, we don't know when it is, that is when we could see some of that 90-degree angle physics. A parabolic uptrend simply doesn't hold. Perhaps reverse, not perhaps, probably will reverse at that point. But to use the words of Steve Sosnick over at Interactive Brokers, until the music stops, people are not taking a chair. But when that music stops, it could be an interesting hustle.
Well, Abigail, just really quickly, you're a technician. You mentioned that parabolic rise that we've seen in the share price. Can you even do technicals on a stock like NVIDIA right now?
Yes, you absolutely can. And from other standpoint, if you take a look at the RSI on the stock relative to its move, first of all, it is almost 100% above the 200-day moving average. That is very extended, close to its highest level over the last 20 years. In the tech bubble, it went well above that 100% above the 200-day moving average, that extension. So it's a question of whether or not we are actually in that kind of a frothy environment, but again, deserved by this company for the growth. But the other thing that I would point out, Katie, is there are very subtle bearish divergences happening for this stock over all time periods, where the RSI is at a lower level of being overbought, which tells you that these new all-time highs, that the investor is buying it a little bit less confident than the last time. So all of this does support that at some point, that 90-degree angle to the upside, that parabolic uptrend will reverse. It's just really super hard to know when that might be.
NVIDIA shares up 180% year-to-date. Abigail Doolittle, thank you so much. Meanwhile, moving on, Dell and Supermicro also rallying after Michael Dell said the company is building a Dell AI factory for Elon Musk's startup xAI. Bloomberg Technology co-host Ed Ludlow joins us now for more. Ed, give us the details.
Well, it directly relates to what Abby was just talking about in NVIDIA, because an AI factory is just a new term that Dell's come up with for server racks, rows and rows of server racks in a server farm. And this is all played out over social media in the last 24 hours. As you said, Michael Dell posted on X that they're making AI factories for xAI to develop Grok. Supermicro was then thrown into the mix by Elon Musk himself, saying that they will also have a part of it. What I find so interesting about this is you can kind of do the math. We talked a lot, you and I, Kate, about how in the context of AI chips, it's not just something you can hold in your hand. It's not just a chip. It goes into a server rack that includes networking gear, storage, high bandwidth memory chips. But our colleagues at Bloomberg Intelligence have basically said, if Dell get just 50% of the xAI deal, and it's to develop Grok 3, the latest generation large language model from them, and you price each server rack at $1 million, it could be a deal that is valued up to $3 billion for Dell, and therefore justify the consensus that the part of Dell's business where they make servers specifically for compute for AI has a 25% growth rate. And it's a part of the business that people were excited about, but we were left a bit disappointed following earnings. So look at what's happening. It's not just Dell and Supermicro rising this morning. HPE is up by association. And I would probably argue that a lot of the gain in NVIDIA in this morning's session is because of that Dell announcement, so to speak, because it is the NVIDIA GPUs that go into those server racks alongside all the other gizmos.
Well, Ed, I know you're going to be all over it on Bloomberg Technology. That is at 11 a.m. Eastern. Ed Ludlow, thank you so much. Meanwhile, shares of Trump media sliding after an SEC declaration that could dilute shareholders. Isabel Lee joins us now with more.
Hey, Katie, shares are now down around 6%. People are worried that this move would fatten the overall supply of shares, thereby lowering the process. So this move, which is long awaited, allows investors in the firm's derivatives, known as warrants, swap their holdings for shares in the company. So again, this could dilute long-time shareholders, which is why the stock is probably down. On late Tuesday, it was lower by 15%, and for the month, it was down around 36%. So if exercised, this warrants could add around $247 million to the company's balance sheets. And of course, historically, some investors who exercise the warrants sell their shares. So of course, this then creates selling pressures. But the company is a little bit more optimistic. They seem to be focusing more on the long term, because we have the CEO saying that they will be well positioned to pursue TV streaming and other enhancements and even potential M&A. Warrants are also known as sweeteners and are common in the SPAC world because they're designed to reward investors. And of course, this is the Trump Media and Technology Group. So Donald Trump is the firm's biggest shareholders with around 115 million shares, worth around $3 billion. Shares are now slightly lower by 8%, so the stock is continuing its slide, Katie.
All right, yeah, definitely falling out of bed there. Down 8% at the moment. Isabel Lee, thank you so much. And we turn over to earnings because we have a fresh report out this morning from grocery chain Kroger. And for more, I'm pleased to say we're joined now by Bloomberg's Natalia Knidzewicz.
Hi, Katie. Yeah, so it was a strong beat across the board. EPS came at $1.42 per share. Analysts had expected $1.35 per share. Comparable sales rose 0.5%, and that was also higher than analysts had expected. The company maintained its guidance for revenue and earnings, and for Bloomberg Intelligence, this is a very encouraging signal. The main takeaway from many analysts I spoke with, they say this is a signal that the company's investment strategy is paying off. Well, first of all, Kroger invests heavily in its fresh department. This is one of the biggest drivers for sales. It also invests in prices, basically by reducing prices, offering promotions. And in today's report, Kroger said that Total households and consumer visits increased during the quarter due to personalized discounts and improved store execution. However, on the flip side, we see that the margin is deteriorating a little bit, and this has to do with lowering prices. But overall, analysts are quite optimistic about the stock. The company got a few upgrades in the past few days. However, analysts, of course, keep an eye on consumers, and they are saying that consumers continue to be selective, Katie.
All right, you have a really interesting read there, of course, on the state of consumer spending, Natalia Kunijevic, thank you so much. Let's stay in the food space because shares of Darden restaurants rising despite Olive Garden's same-store sales falling for the second consecutive quarter. Joining us now is Michael Halen. He is restaurant analyst for Bloomberg Intelligence. And this is an interesting one because actually you take a look at the outlook and it was a little bit disappointing, and typically that would be a sell sign, Michael.
Yeah, but historically, Darden is pretty good at issuing guidance and beating it. They're good at playing the, playing that Wall Street game. All in all, it was a solid report. They topped industry same-store sales in the quarter. Their margins, continue to be best in class. Investors love Darden. It's a very well-run company. Operations are great, and they have some advantages in this consumer slowdown, namely scale. They can continue to price below inflation, which they've been doing for years, and that's kind of eased some of the traffic decline. And and they have great tenure for their employees, right? And so the experience is usually good in the restaurant.
So a story of under-promise, over-deliver. You have to get better at that one. Let's talk about the portfolio here because we talk about Olive Garden all the time. Of course, it's the parent company of Olive Garden. You take a look at comp sales for that specific brand. They were disappointing. Longhorn, though, definitely beating expectations on that metric.
Yeah, consumers seem to be frequenting these steakhouses. They seem to have done better. They seem to do better when there's beef inflation, right? I guess there's a few things going on. Part of it is Longhorn's raising prices more than Olive Garden is, right? And so that's part of the reason why the same-store sales are higher. But also when we see beef deflation historically, we see steakhouses outperform. So I think people are looking at the price in the grocery store versus the price they get at Longhorn. Also, they don't have a 1,000-degree oven in their house, and so Longhorn can cook a steak better maybe than they can. And I think for those reasons, we see steak chains do pretty well during recessions, during times of inflation. And, it's not just them, but Longhorn's done a good job.
Yeah, and you've definitely seen that in these results. Talk to me more about the pricing strategy. You mentioned, of course, they can adjust pricing here. It sounds like they have some history of doing that. When it comes to that specific lever, though, how eager are they to do that? How quick would they be to respond?
Yeah, they're not very eager at all. For the last 4 years, they've underpriced inflation pretty significantly. And it's a smart long-term strategy. Management talked about it on the call. It's like when you get into that, you get into that cycle of pricing over the long term, people are going to really cut back more on their visits. And so people can view a place like Olive Garden, they can view Longhorn as places that can continue to provide value in this inflationary environment. And, as I mentioned earlier, their scale really helps them do that.
And before I let you go, just quickly, you are fresh off the earnings call. What was the big topic of discussion on that one?
Yeah, I think some of the key points were, they talked about the consumer and how the consumer continues to be weak, especially consumers and households earning less than $75,000 a year, in particular, $50,000 a year or less. They continued to talk about their strategy of pricing less than inflation. They're expecting about 3% inflation this year, and their pricing strategy is is for 2.5% to 3%. I'd say those are the two main takeaways. All in all, it's more of the same, which investors should like, right? You don't want any surprises. You want management to continue, on the path that they're on, as long as it's successful, which Darden clearly has been.
Well, Michael, great to speak with you. Appreciate your time. Our thanks to Michael Halen of Bloomberg Intelligence. Now, coming up, we have Frank Monkham. He is Senior Portfolio Manager over at Antimo, why he believes election risk isn't properly priced into the market. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Joining us now, we have Frank Monkham. He is Senior Portfolio Manager over at Antimo. It's great to see you in person.
Pleasure to be here, Katie.
Let's talk about tech. We were having this conversation with Samir Samana just about 30 minutes ago or so, and he made the point that he doesn't think that what we're seeing when it comes to the fundamentals of some of these tech names actually justify the valuation. So what's your view? Can we call this a bubble?
I think trying to have a discussion around whether it's a bubble or not, it's not really the right discussion to be having. I think we're clearly at the foothills of a bubble at the minimum. The question is it a big bubble, small bubble, medium-sized bubble? We had to look at, where the market is today in terms of positioning, momentum, RSI. Everything looks very, very overstretched. The problem is with bubbles is, people think that bubbles are, some kind of cataclysmic event happening in the market. It's not, right? It's a feature, not a bug of markets, right? So the way you got to look at it is say, am I in a bubble, yes or not? And when you answer the question yes, is to have a game plan to be able to trade around bubble markets. And I think we are in a bubble. And the way to trade around it is to look for downside protection. And the problem, the issue with this market is people are failing to realize how cheap volatility and skew is. So it provides an opportunity to really, protect yourself to the downside at a very, very cheap cost. So I think the question as to whether we're in a bubble or not is not really the question that we should be posing ourselves. Is more so how do we trade around the bubble market?
Well, let's talk about that downside protection, because you take a look at the VIX, for example, it's been doing nothing for quite a long time, currently trading with below a 13 handle, and it just seems like nothing seems to shake this market. So when you talk about downside protection, over what timeline are you considering?
That's actually a very good point. I think that, the way to trade around bubble markets, the playbook for that is not to try and short the market directionally, is to look to play non-linearly via options. And, put strategies are very efficient, especially here, where, like I said, where vol and skew is really cheap. So what you want to do is basically ladder out your risk as you put in on this, put spread structures over time, so that you're kind of minimizing your theta decay. And when you think about the VIX today, one thing that kind of should be garnering investors kind of, the investors kind of respect here in this market is the fact that you have to look at what's going on with volatility in Europe, right? The V2X and the VIX are currently diverging pretty materially, and this type of divergence really doesn't last too long. So what I mean by that is, in addition to the fact that the market is really straight to the upside, I think as we start to trade into Q3, the market probably is going to be rotating away from this momentum theme into what's going on with geopolitics and politics around the election cycle. I mean, we've got the U.S. here, the debate next week on June 27th. We've got the snap election in France on July 4th, and the UK election on July 4th, rather, and the France election on July 7th. That's an opportunity really for investors to really try to start to hedge the downside here as we flip into the election cycle in the next quarter.
Well, let's stay stateside, because like you mentioned, the first debate is in 7 days' time, and then of course November we have the real deal. And when you think about election volatility, there's not much priced right now, but should there be? Because you consider a Trump versus a Biden presidency, we know both of those candidates in both of those administrations.
Yeah, we do. And one thing we do know about either candidate is that it's going to be fiscally. It's going to be fiscal profligacy. We know that profligacy. Whether it's Trump or Biden in there. On the Trump side, you've got tariffs. You've got a crackdown on immigration. On the Biden side, you've got the Inflation Reduction Act. That's still inflationary. So I mean, I think it makes it easier for investors actually, because you don't have to try to figure out which candidate is going to get in there to get a clearer picture of what the inflation outlook is going to look like. Regardless of who gets in there, inflation is going to be a problem, and the fiscal path of this country is not going to change regardless of who gets in the White House. So again, there's so many signs to point to the fact that this time is ripe for investors to really look at some cheap downside protection.
And I have just about a minute left. So that cheap downside protection, when you think about the upcoming election, I was going to ask you, what's the best way to protect for that? Is that through the volatility market, or is it through something like commodities, for example?
Well, that's actually a very good point. Commodities also provide a tremendous amount of hedging around inflation risk, right? But the thing with commodities nowadays is you have to be able to think about what your inflation hedging framework looks like. So if you're looking at a hedge from an inflation that's coming from a cost push perspective, then you want to think about things like energy and ag. If you have an inflation that's more of a demand pool, then you have to think about things like copper and alley, right? But if you have inflation that's more about central banks continue to be, staying in easing mode and kind of losing their credibility, then you got to think about things like gold, right? And I think commodities provide a huge amount of, downside protection when it comes to inflation. And the thing is, with commodities at the time, at where we are in the market today at this juncture, is you have to be really selective on which commodity you actually allocate to. So it's not just a beta allocation to commodities. It's basically trying to pick and choose which commodities make sense here, where you are in the cycle, and where you are kind of, the supply-demand picture, right? And we've seen what's happening recently with copper and gold and oil, where positioning really has driven a lot of moves that we've seen in these markets. So there's a lot of technicals also that are at play, and that's offering some kind of relative value opportunities that comes from mispricings between these different types of commodities. So I think investors, in addition to saying, hey, we want to be allocated to commodities, I think we should get our hands dirty a little bit more in trying to figure out which commodities make sense at which time frame here as we head into the second half of the year.
Well, we'll have to pick up this conversation again soon. Frank, great to see you in person. Our thanks, of course, to Frank Monkham of Antimo. And for some of the sector price action this morning, let's get back to Bloomberg's Abigail Doolittle.
We're looking at a modest gain for the S&P 500 right now, Katie, up about 0.3%, up for a third day in a row, heading to another record close, carving out an all-time high. Currently, the top sector on the day is energy, up about 1%. Speaking of commodities, we do, of course, have oil up about the same amount, so helping out there. Utilities, interestingly, higher, even with yields higher. Those dividends should look less attractive relative to high yields, but the narrative, of course, this year is that it's an AI play, so anything AI is higher. Real estate and healthcare both down. Those are, well, at least healthcare, a defensive sector, so the fact that it's down, that is almost a risk on signal, but small moves. As for one sector that's making a bigger move over the last few days, that is the home building sector, currently higher today, but over the last 2 days, down 1.9%. And Lennar, a couple of days ago, of course, put out results that were not received well by Wall Street, but KB Home today, that stock up nearly 5% as they maintain margins despite incentives to sell their homes.
All right, Abigail, thank you so much. Coming up on this program, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
All right, it's time now for the trading diary. What you need to be watching today and the rest of the week. We get oil inventories later on this afternoon, plus Fed Speak with Fed heads from Barkin and Daly later on today. We round out the week tomorrow with earnings from CarMax and, of course, existing home sales, because already Friday coming up tomorrow. Meanwhile, this was the Countdown to the Open. I'm Katie Greifeld, and this is Bloomberg.
names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. We'll get the latest on some of that housing data we got this morning. A little bit weaker than expected. Drew Redding, Bloomberg Intelligence. He's a home building analyst. He'll break it down for us. Tim Craighead, he's one of the head honchos over Bloomberg Intelligence in London. He also covers the European market, so we'll get the latest on the outlook for European investing. Woo Jin Ho, Bloomberg Intelligence senior tech analyst. He's going to talk to us about some of those hardware companies, Dell, Supermicro, all kinds of stuff here. We just can't get away from the AI theme, and it is all over the tech space driving this market. So we got a busy first hour coming up. We're also going to be on the lookout for some Supreme Court rulings due today and tomorrow. If anything of note comes out, we'll break that for you. But right now, let's go to Lisa Mateo and get Bloomberg.
You got it. Market Drivers brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, to the markets we go, where stocks are advancing, and this is after the market holiday and after also some more economic data. We had initial jobless claims. They fell by 5,000 to 238,000 applications last week, and that was from an upwardly revised 243,000 in the prior week. Now, meanwhile, new home construction in the U.S., that slumped in May to the lowest pace in 4 years, down 5.5% after a gain in April. And then building permits, which is that good look at future construction, that's at a 4-year low too, down about 3.8%. So now we have the NASDAQ up about 0.2%, 45 points at 17,908. The Dow up 0.2% at 107 points, 38,940. The S&P 500 up 0.2%, 14 points at 5,501. All right. Meanwhile, we do have Europe European stocks, they strengthened. The Swiss National Bank, that delivered an interest rate cut. The BOE maintained its key interest rate, 5.25%. We had the stock 600 up about 0.6%. Now, as far as currencies, the dollar edging higher against the Japanese yen, euro, British pound, the euro 107.28 against the dollar. That's your Bloomberg Business Flash. We'll send it over to you, Paul and Alex.
All right, thanks so much, Lisa Mateo. Also, happy solstice, guys. This is the longest day this year. Did you know this?
I did.
Yes.
This is big.
This is the big day. We're gonna.
It feels like it.
Yeah. Just wait till it's 6 p.m. and the sun is still at high noon. Some breaking news for everybody here. The Supreme Court is upholding in 2017 a U.S. tax on foreign business income. This was American-owned companies and their foreign profits, and they're upholding that 2017 tax. We're going to get more on that in just a moment. So it's a solstice, longest day, and yet another record.
Yes.
Shocker, 5,500, right?
Exactly. We had somebody on from Federated Hermes, and they still have a 5,200 year-end target, but they said it's going to be a choppy summer, but they do see the market at Federated Hermes going to 6,000 next year, which I think feels kind of consensus E.
It was. It does. It was huge. It's interesting to see the huge spread between the bull and the bear case among strategists.
Yep.
Like, that's quite wide. I mean, we did also see that last year, but before then, we haven't seen that in quite a long time, which I find to be very interesting. And also, I think the idea of the rebalancing tomorrow, ETFs, you got the indices, the options. Oh, Paul doesn't care about this.
I have to pay. I mean, that's at at the end of the day.
Yeah, well, but you also have to sort of like buy and sell before that.
Okay.
So you're seeing some moves there. And also just options can create some volatility. So I know that over at Goldman Sachs, Scott Ribner is calling it a liquidity event.
All right, I got people that take care of that.
You have people.
Yeah, I have people.
Are you off tomorrow? Because your outfit says that this is your Friday.
But this is my heat wave attire. So if I had to, if someone were to walk by and look for need a fourth for golf, then they could just pluck me right out. We could hop on their jet in a minute and could be anywhere to play golf. Now, he hasn't done that in 14 years.
Right.
But he could.
You want to be prepped.
I'll be ready.
You're going to be ready for that, which I appreciate. Paul is wearing a polo and a zippy, and usually he's in a suit. This is why I'm commenting on his attire. Okay, so we have S&P over 5,500. Shocker, NVIDIA still doing really well. It's just all these AI plays also. Super Micro also up as well. Carmen Reinecke is joining us for some of the individual movers. Carmen, what are you looking at today?
Yeah, so as you said, we're looking at NVIDIA, Dell, Supermicro Computer, some of these big AI plays. Obviously, NVIDIA on Tuesday, finally kind of catapulted over both Microsoft and Apple to be the largest company by market cap in the world. So seeing it rise for another day is really just kind of incredible, although also sort of become the NVIDIA story. Shares right now of that are up.
We had BlackRock in here today, strategists for BlackRock, all in NVIDIA AI. I mean, they're just all in. Like, you raise a question about valuation, we're not worried about it. This is the seminal growth story, AI in general, NVIDIA in particular. So, I mean, and I guess if you look at a lot of the big portfolio managers, they're all in on this tech trade.
I was just talking to a hedge fund guy, and it was basically like, yeah, of course we're in a bubble, because that's what happens, but we have no idea how long that bubble is going to last, or what it looks like, or how it winds up bursting. Someone else I was talking to the other day reminded me that, look, if you have a $5 million house and someone offers you insurance for $1,000, you take it and you buy it. And that's the idea that, like, any hedge against any of this stuff is so cheap, and no one's still buying protection is a little bananas.
Interesting.
Yeah, so those moves right now, Supermicro, SCMI is up 8%, Dell is up, it's come in a little bit, up 3%, NVIDIA up also about 3%. One of the reasons that they're moving this morning is that Michael Dell said in a post on X that the company is building a Dell AI factory for Elon Musk's xAI startup alongside NVIDIA. Elon sort of confirmed that those companies are working together along with Supermicro Computer. So that's giving it a little bit of a boost today. The other AI name that we were sort of looking at this morning was Accenture. So not one that I'm looking at a ton, but it was up as much as 11%. Now it's more in the 6% range after reporting earnings. Overall, the earnings weren't like a huge beat, but it did show that it had a big jump in growth in generative AI bookings. So that was really positive. Analysts overall said the report was much better than feared and showing some strength in a part of their company that's obviously been a really key growth area for the market right now. So seeing Accenture shares up this morning.
Yep. Less bad than feared.
Yeah, okay. That's fine with me.
Yeah. We like that. We do that. Okay, anything else you're watching?
No, those are the big ones this morning. It's a little, volume's a little low today. We're, just back from the holiday, but yeah,
I like
it's
that
all AI.
the midweek holiday in June. We'll take that. Carmen Reineke, thanks so much for joining us. Carmen Reineke, she follows all the equity markets for us. Again, we're on the watch for some Supreme Court rulings here today. We did get one. The U.S. Supreme Court upheld a 2017 tax on American-owned business foreign profits. June Grasso, Bloomberg legal analyst, joins us here in our studio. Not one of the real sexy ones, but
not even on the most watch list.
Not even on the most watch.
Maybe on Bloomberg's
Don't
most watch
care?
list.
These are taxes,
well,
right?
companies care, but the average American citizen who's looking for the hot button issues doesn't care about this. I mean, if they had not ruled this way, it would have sent the Internal Revenue Service into a frenzy trying to, restore taxes that were paid and also some of the, the rules that they have. So this basically was two people who owned a minority stake in an Indian company in India, and they said that they shouldn't have to pay the taxes that were allocated to them because they hadn't gotten any profits from the company. And, this is the 16th Amendment, which I think law school was the last time I ever heard about the 16th Amendment. And so, the justice says this is no different than any other tax. And the fear was that this would enable a wealth tax if a wealth tax ever comes. And that was the only fear, really, from this case. So it's 7-2. That tells you that there wasn't much problem.
And what else are we waiting for? What are those hot button issues? Everything.
My gosh, well, first of all, we're waiting for the abortion case from Idaho about a state law that basically makes it only possible to have an abortion if the life of the mother is in jeopardy. We're waiting for a gun rights case, which is based on the Second Amendment, which is whether there's a law, a federal law, that people who have domestic violence, abuse charges against them, or who have the man in this case had a domestic violence temporary restraining order, can't have a gun. That's another one. There's the Texas and Florida social media cases, whether or not social media companies are allowed to look at what they have and pick from what they have and knock things off their platform. There's a case that will make people's eyes sort of glaze over, but it's really, really important. It involves something called Chevron deference. And this involves every agencies, whether or not you're going to give deference to an agency's interpretation of a law that's ambiguous, or whether the court should be the one to interpret it. And so several of the conservative justices have been trying to get rid of Chevron deference for years, and the question is whether or not, and it's something that conservatives have been trying to do because they don't like agency authority.
Because in part, because of the EPA, right? Because the EPA has large latitude. I know it goes all across.
It's the EPA, it's banking, Social Security, you name it. This would, anything involving an agency, this would affect. Okay. And I think the Labor Department is the department that has already started not relying on Chevron deference in proposing rules because they're afraid of what the Supreme Court may do here. I have to look up what it is, but I think it is the Labor Department.
All right, June, please stick around if you can, because we may get some more Supreme Court rulings. And
we definitely will.
Have you run back and forth, so if you can hang out for a little bit, that'd be great. We also want to get to some of that economic data that broke earlier today. New home construction in the U.S. slumped in May to the slowest pace in 4 years, as higher for longer interest rates sapped the housing industry's momentum from earlier this year. Drew Redding, we pay him to do this stuff. He's a home builder analyst at Bloomberg Intelligence. Drew, what's happening in the home building business construction?
Yeah, so a pretty big miss on the headline today on the housing starts number. Not all that surprising. You have to remember rates went up to 7.5% last month, and they're still hovering at around 7%. We also had some weak data on the home builder confidence side. But these numbers are also being impacted by, you want to parse out what's happening in the single family side versus the multifamily side. And the way we tend to look at it is non-seasonally adjusted on a year-over-year basis. So we had total starts down 20%, which is a pretty big number. But single family starts were actually up 3% and multifamily is down 57%. So that's a lot of the story right there. And if you look year to date, total starts are down about 4%. Single families up 19, multifamilies down 40. So that dynamic is one thing at play. The other thing that we've talked about in the past is the relative advantage of the big, well-capitalized, publicly traded home builders. And we just had some data from Lennar, who just reported results, which lines up nicely with what we just got on housing starts. And if you look at over the last 6 months, their starts are up about 20% year over year. So, a couple stories. It's the single family side, and then it's the big public builders.
Well, what did we learn from KB Home on that front? Because that usually caters to sort of the entry-level buyer, Lennar more high-end.
Yeah, KB had great results pretty much across the board. Okay. Their results told us that demand remains strong, that buyers are still responding to the use of incentives. It also tells us that incentives probably aren't going away in the near term. When we came into the first quarter, there was an expectation that, hey, look, rates came down to, 6 3/4. Maybe builders are going to be able to pull back on their use of incentives a little bit, and that would help margins in the back half of the year. But it looks like with rates back at 7, they're going to remain elevated, which will put a little bit of pressure on margin. So it's a demand versus margin story, and buyers are still responding to incentives.
Drew, kind of where are we in this country in terms of supply of housing? I know for a while the story had been we're at a deficit. There's not enough housing. Is that still the case?
Yeah, that's a great question. And, one of the main speaking points for the builders was there's nothing for sale on the existing home side. People don't want to list their homes because they don't want to trade in their rate. We're starting to see a little bit of a shift there. If you look across the country, inventories are up about 13% in the last month. That being said, if you take a step back, they're still down about 30% from pre-pandemic levels. But what's interesting is kind of what's happening across the U.S. And if you look at certain markets, you're starting to see, some warning signs. And, some of the ones that come to mind are Texas and Florida. In Florida, you've got inventories in some cases rising over 50%. Wow. And are actually above 2019 levels by, 50 to 75%. A lot of that's concentrated in some of the West and Southwest markets, but it's something certainly to keep an eye on because, as that inventory increases, the advantage builders have had diminishes.
Huh, that's interesting. What are some of the other sort of hotspot areas? We had a great piece out talking about, was it Tennessee? Was it Tennessee that is attracting all the people from the West and East Coast and is sort of pricing out all of the people that actually live there? Like, how do big waves like this, like we saw in Texas, like we did see in Florida, how does that wind up affecting the housing market?
Yeah, there has been a lot of movement out of some of those high-cost markets, from coastal California, maybe inland, and then into markets like Las Vegas and Phoenix. What we're seeing from a demand perspective is kind of interesting. At the national level, demand in the new home market has been relatively strong across the board, but we have seen markets kind of move in cycles. So if you look at the hardest hit markets back in, the second half of 2022, when rates really shot up, you had, California, Washington, all the markets across the Southwest. Those have actually come back pretty strong. And it's now some of the markets that were leading. You think about the Texases and the Floridas, which are the two largest markets, are now starting to soften a little bit from both a pricing and a sales perspective as inventories start to rise. So, those markets, big picture, are still benefiting from out-migration into some of the lower-cost markets. That's why you've seen the Southeast and Florida do so well. But at the same time, we are starting to see a little bit of a slowdown there.
A friend of mine just put her house on the market yesterday, and I told her, I don't even think you're going to get to your open house on Saturday. I think you're going to have like a gajillion offers come in. And you're going to get, so we'll see. I'll check in, but it's just one of the things, you just don't see existing inventory coming onto the market that much. And when it does, particularly in a pretty middle-of-the-road price range, I got to think it's just going to be snapped up like crazy.
The 7% versus 6% interest rate doesn't matter as much anymore, is what you're saying.
Yeah. I don't know. We'll have to see. So, Drew, is there a sense that rates have to come down for existing homes to really move?
Well, I think you want to see rates get into that 6.5% at least to see things start to loosen up a little bit. But what's interesting, and Alex, you mentioned it, 6 versus 7. There's not a whole heck of a lot of difference there, and you have to remember the people coming to the market now are coming with that higher rate mindset versus, what they were a couple of years ago. So people have certainly started to adjust. And at the same time, we're still transacting at these higher interest rate levels. So that mortgage rate lock-in effect that we've talked about previously, it starts to gradually loosen a little bit because you've had more buyers purchasing at higher rates.
All right, really great stuff. Drew, you're the best. We appreciate you. Drew Redding, he covers home building for Bloomberg Intelligence. Does a great job there for us. And just to reiterate, we saw earlier, just about 10 minutes ago, the Supreme Court is upholding a 2017 tax on foreign business income. It kind of goes as expected. The decision was 7-2. Here's something you don't see every day, Paul. The NASDAQ is losing steam. Down by 0.2%.
Exactly what's going on out there.
I know. The S&P 500 breached that 5,500 level and now has sunk back down. I say sunk back down because it's still at 54.90. Volume very high as well. Tomorrow, quad witching, lots of options expiring. Could be a liquidity event. This is what I keep hearing from people on the street. We're going to bring you much more. This is Bloomberg. Happy Thursday.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, it's been quite a morning. The S&P 500 topped the 5,500 mark, heading toward another all-time high. NVIDIA leads the tech gains, extending its lead over Microsoft and Apple. Shares of NVIDIA up another 1% right now. The S&P 500, let's check in with it right now. Shares little change, up about 4 points at 5,491. Now the NASDAQ, if the NASDAQ 100 finishes higher, it'll be its 8th consecutive day of gains, the longest winning streak since November. But right now, Tesla down about a tenth of a percent, down 28 points at 17,832. We'll head to the Dow. That's up about 0.4%, 156 points at 38,990. All right, let's get to the bond market. The 2-year yield, 4.74%. That's up 2 basis points. The yield on the 10-year, 4.27%. That's up 5 basis points. Commodities, we have spot gold higher at $2,358 an ounce. WTI crude, $82 a barrel. We have Brent crude at $85 a barrel. Since we talked about NVIDIA, let's continue with that. So we have Michael Dell posting on X saying that Dell building an AI factory with NVIDIA to power xAI's Grok supercomputer. Now, Musk responded to that post. He said that Supermicrocomputer is going to be providing those servers. So now you have shares of Dell and Supermicrocomputer both on the rise. Dell up about more than 1%, Supermicrocomputer up 6%. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and analysis with our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. You're looking at the market, Lisa was just saying, still holding on strong, maybe off the high. Sure, we're under 5,500 for the S&P, but we are on track for now, 32 record closes so far this year. Tim Craighead is Bloomberg Intelligence Global Chief Content Officer, and he joins us now for his take. Tim, there's lots of different theories going on as to why we keep grinding higher here in the U.S. And one of them that I keep hearing about is safe haven inflows from Europe, because of all the political question marks there, into the U.S., into the safe haven of quote-unquote tech. Do you buy that?
I do buy the idea that there is increased uncertainty over here in Europe, and it is, I think, election cycle driven coming out of the blue. European markets started to take a little bit of a pause in May, and with the elections early this year and early this month with the European Parliament, that all of a sudden ended up unexpectedly pulling a snap election with France, I think is a bit of a shock, and that has rocked what's going on with the euro. It certainly has had impacts on what's going on from an interest rate perspective. And it's taken a little bit of the momentum out of what had been a pretty good early in the year rise in the markets here.
So, Tim, give us a sense here. We know that the European markets have a much lower weighting in technology than we do in the U.S. In the U.S., this is just AI on steroids, it seems like, for the market over here. That's all people want to talk about. How do the European investors think about AI? Is it such a big topic over there?
Well, I guess it plays through in a couple of ways. And I know you guys have talked about this ad nauseum, whether it's with Gina Martin Adams or others. But, you look at the S&P versus the equal weight S&P, and those are two totally different beasts. Over here, you're right. Technology is much smaller. You've got companies like SAP that is doing what it's doing. There's a little side play with how you think about enterprise resource management software playing into the data that drives AI. And you've got ASML, which is absolutely an AI play, along with NVIDIA from a semiconductor perspective. That's kind of about it. There are a couple of other semiconductor companies like ST Micro and Infineon, but they're not AI plays per se. So it is much more limited within that scope, and it's a much more traditional investing market that doesn't have that sex appeal, if you will.
Well, but what you do have are rate cuts. So you have the S&P with its second rate cut. You also have the ECB with a cut. It looks like the BOE may be doing a cut in September. At least that's what the markets took today as, that there was not a lot of distinction between. It was a fine line between holding and cuts today. You guys got that.
Yeah, and it's true and it's needed. You think about valuation here from an equity market perspective, and we've come back up to pretty normal levels across many markets in Europe. And what's needed to help boost valuation from here is, number one, earnings. And we've had 3 pretty lousy quarterly reporting periods. We'll chat about that. But also what happens with rates. And I do think you have to take that with a little bit of a grain of salt. The good news is headline inflation rates are certainly falling. We hit 2% here in the UK, which is great. But the services numbers, parts of the core numbers, are still a little bit on the sticky side. Our view tends to be, along with Bloomberg Economics, that the ECB basically sort of forced themselves into a corner and had to cut 25 basis points. Whether they would have if they hadn't been talking so overtly about it, maybe not. But it's going to be a little while before they come back again. And with the SNB, that was more of a reflection of what's going on with the Swiss currency relative to the euro.
Right.
And, it's taken off here as of late, and they had to do something to pare that back.
So, Tim, here, talk to us about earnings over there in the European sector, because the U.S. earnings have been pretty darn good. How have they been over in Europe? Because we know, obviously, a lot of those big European companies, big German companies have exposure to China.
Yeah, well, they have exposure to, on the one hand, they have exposure to China, which, in many instances, isn't so great, whether it's the autos or the industrials. But certainly there's a broad swath of exposure to the U.S. as well, which is an offsetting positive in many ways. But to get to your point, Paul, we have had 3 quarters of pretty lousy earnings, negative earnings growth here, earnings contraction. That was sort of what we saw in the U.S. in late 2022 into 23, and it was kind of 9 months late coming here in Europe. And interestingly, this last quarter, which was down 5% in earnings on a year-over-year basis, that's the bad news. The good news is we're set mid-year and into the second half to start to grind a bit higher. Mm-hmm. And, we get through these elections in early July and get into the mid-year earnings cycle. That actually could be a catalyst to look forward to.
I mean, let's look forward to that, because I feel like we've heard this story many times, and every time we think Europe's going to get that bid, it has a mini bid, and then it goes away. What is different, and I put in quotes this time around, is maybe the luxury guys have sort of come off the boil. So they're not as high as they were. We've kind of taken out some of the froth. Maybe that could be a good starting point. Same could be said for some of the weight loss drugs. What are the tech plays that are not tech in Europe?
Well, you just mentioned an important one, and that's pharma. You think about Novo Nordisk. There's others that certainly have a lot of bright prospects as we look into 2025. And, the market's going to start shifting that way very quickly as we get into mid-year earnings and management start talking about, forward prospects. AstraZeneca, has been beaten up a good bit coming off the boil from its COVID positives. There were disappointments last year. That's starting to cycle back up. GlaxoSmithKline is starting to cycle back up. The best sector in the UK over the course of the last couple of months, where it had a nice move forward, has been healthcare. So it's nice to see that area coming back into focus. And I would say within the industrials, the European industrial base is pretty bright. There are a lot of positive stories there to be told. A lot of that revolves around energy transition, number one, and number two, automation, and that gets further boost, if you will, as you think about starting to deploy elements of AI and efficiency, et cetera. So,
hey, Alex, first with Goldman Sachs, and then now with Bloomberg, Tim Craighead has worked all over the globe. I mean, we send them everywhere, Asia, London, all that kind of stuff. So, Tim, my question is, I'm thinking about it. Have you lived more years out of the U.S. or in the U.S.? We're getting close, aren't we?
Yeah, it has. Having started in the business in '87, I've now spent, 13 years in the UK and 5 in Hong Kong. So it's getting to be a chunk.
But you know what? He doesn't have one of those weird accents that people do.
Well, he's from Roanoke, Virginia, rural Virginia, and now he's about as far
As you can get.
I mean, Hong Kong was probably as far as you
But like, I don't hear the Madonna accent, like that affected weird. I lived in the UK, therefore I speak weird.
Nah, he's old school.
We can talk Southern if you want to. So there you go.
Exactly.
Love it.
All right,
Love
Tim.
it.
Thanks for checking in with us. Tim Craighead, Global Chief Content Officer. He follows the European markets for Bloomberg Intelligence, doing the work from home thing in London, which I think they do that one day a week too.
Do they?
Yeah, but he bicycles into work every day. I'm talking even in the wintertime. Like it's crazy.
Well, because they don't get like storms in the same way that we do. Like at that point, it's just rain.
I don't know.
Like maybe once in a while a little snow and that's crazy, but like not in the actual city. That
And in our
okay.
London office, we have a lot of people that bike into work. They have a big room for the cycles.
You want to know why? Because they have congestion fees.
Yeah, don't.
So I know. Well, John Tucker's not here, so I can say the word. And that's part of the reason why.
That's one of the reasons, but he's kind of does that cycling thing anyway. So anyway, good to get a good perspective on the European markets with our news in New York City. Here's Michael Barr.
Thank you very much, Paul. Alex and Lisa. After 2 days, a hard-fought congressional primary in Virginia's 5th District is still too close to call. It's pitting the chairman of the conservative House Freedom Caucus, Bob Good, against a Trump-backed challenger, State Senator John McGuire. We get more from Bloomberg Government's Jack Fitzpatrick in Washington.
McGuire is ahead by a little more than 300 votes at this point. If it stayed there, it would be within the 1% margin that would allow Good to require a recount. So this is very, very close. It's too close to call. The AP has not called it yet.
Bloomberg Government's Jack Fitzpatrick reports Trump endorsed McGuire after Good backed Florida Governor Ron DeSantis for president. The Supreme Court today upheld a tax on foreign income over a challenge backed by business and anti-regulatory interests. The justices, by a 7-2 vote, left in place a revision of a 2017 tax law that is expected to generate $340 billion, mainly from the foreign subsidiaries of domestic corporations that parked money abroad to shield it from U.S. taxes. Tropical storm Alberto, the season's first named storm, moved inland over northeast Mexico, bringing heavy rains to the parched region and leaving at least 3 dead. The storm was expected to weaken rapidly over land, but carry several inches of desperately needed rain inland to Mexico as well as South Texas. A second person is dead as a result of wildfires in New Mexico. Officials say the flames have now burned around 1,400 structures. State officials say the incoming weather is raising the threat of high winds and flash floods. New Mexico Governor Michelle Lujan Grisham.
We are not out of the woods. And while this weather is helpful to the fire, not helpful to the floods.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are advancing, and this is after more economic data. We also had more signs the labor market stalling, initial jobless claims hovering near a 10-month high, 238,000 new claims. They were filed last week. We also learned housing starts, building permits dropped to 4-year lows in May. So right now we have the NASDAQ, little change, up about 11 points at 17,873. We have the Dow up 0.2%, 77 points at 38,912. The S&P 500 up 0.1%, 6 points at 5,493. We have the 2-year yield at 4.75%. That's up 3 basis points. We have the 10-year yield at 4.28%, and that's up 5 basis points. To commodities, we have spot gold higher, 2,358 an ounce. We have Brent crude at $85 a barrel, WTI crude at $82 a barrel. What's moving the markets this morning? Well, the shares of Trump Media and Technology, that's down about nearly 12%. That's after an SEC declaration that could dilute shareholders. And then business consulting company Accenture up nearly 7%, reported better than expected new bookings for the third quarter, and that included a surge in its Gen AI offering to more than $900 million. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. I'm looking at a story here. Dell Technologies shares rose Thursday after Chief Executive Officer Michael Dell said the company is building a Dell AI factory for Elon Musk's startup xAI alongside NVIDIA Corp. A lot of big names in the first opening sentence there. Let's check in with Woo Jin Ho. He covers all the tech stuff for Bloomberg Intelligence. Woo, what's going on here with Michael Dell?
Yeah, so Michael actually posted a Twitter post on some of his AI server racks that's going to go over to xAI, which is Elon Musk's AI startup. Elon Musk actually followed up and saying, "Hey, yeah, this is happening, but we're only going to split. We're going to split the deal with both Dell and Supermicro, and you're seeing Supermicro rise as well."
Can you just walk me through like what this all looks like? Like when I hear that headline, they're going to provide servers for AI, X Tech, whatever, Twitter, Musk thing. What is that?
Yeah, so essentially you need specialized servers to help build or help support large language models. If you think about the AI build out over at Meta or at Google, you need, hundreds, thousands of GPUs to help support it. And each of these server racks are going from roughly 100,000 per rack for a traditional server rack. And what I calculate is going to go to about $1 million per rack, all clustered together. So, we've published that this one deal could be upwards of $3 billion split 2 ways between Dell and Supermicro.
Connection lost.
All right, I'm going to ask the Alex Steele question. As I'm looking at this photograph that was a part of the Twitter spot for Mr. Dell, I see a big factory, lights, air conditioning, all that kind of stuff. I mean, how are they going to power all this stuff? Did they ever talk about that?
Oh, I love you asked this question.
Yeah. Well, look, Elon Musk, I've actually seen some of the layouts or where this AI factory may be going to, and they've actually allocated the power for that. Now, near term, I think the power needs should be fulfilled. You don't do the planning without the power. But longer term, I do think there might be some issues in terms of getting the land necessary, the data center land necessary to build out these AI data centers because of the amount of power that they're going to suck up. Some solutions may be small nuclear power plants set aside to these data centers, but there's some regulatory issues along with that.
Although I was reading that potentially something might be sent to President Biden today that would make it easier for nuclear. And I wonder if that's all sort of playing into the energy transition, but also the big data centers. So you said it could be worth as like $3 billion. So they've entered into this agreement. When does like a Dell and Supermicro book that revenue? Like, does that show up on its order book?
Well, I wouldn't be surprised that's already in the backlog numbers.
Okay.
In the backlog numbers today. One of the things, the metric that I'll share with you is that Dell did $1.5 billion in AI server sales in calendar 2023. I have them going at around $7.6 billion in calendar 2024. Supermicro, they're probably on pace to about $18 billion in calendar 2024. What this is telling me is that not only are you getting more AI or larger AI server deals, but you're getting more AI server deals going forward.
So Dell, Supermicro, those are two ways to play. What else in your space kind of fits into that AI theme here?
Well, I mean, you know, my colleague, Kunja Sobayani, he covers the chip space. NVIDIA, everyone knows. Broadcom, which has rallied over the last few days, they are a leading AI chip player. On the networking space, Arista Networks is one of the vendors to know. There are some other guys, such as Cisco and HPE, but they'll be more enterprise-focused, at least for the time being, and won't have as a sizable impact from AI on their numbers, at least in the near term.
So when I'm talking in panels and stuff, and I hear people like, okay, this is definitely a bubble. It will definitely burst. We don't know when and how and why. We definitely want to buy puts. Like, we're definitely in a bubble. We just don't know what that looks like. What do you, who are combing through the numbers, think?
Yeah, so we published our valuation note for Supermicro today, and I'll tell you, much of the stock rise of the last couple of days or the last year or so has been more earnings driven than anything else. And it goes back to the fact that a lot of these AI systems have this humongous ASP boost. I mentioned $100,000 a rack. The latest generation of NVIDIA's servers, they're going to be about $3 million per rack. And that's going to support their $25 billion in fiscal 2025 expectations. And I think that if you think about a housing boom, we are going through an AI housing boom right now, and this is going to last for the next couple of years. Now, when does this housing boom bust? Still too early to tell, because first it's going to be the cloud. The enterprise is going to start following. I don't know how big that enterprise opportunity is just yet.
Any sense there, Wooj, how much of this incremental AI spending is in fact incremental to overall tech spending, or is it just taking it from other buckets?
Yeah, that's a good question. And if we look at the companies or the sectors from a sector basis, within hardware, we've seen some of the traditional hardware lag in terms of spending. I do blame some of the declines in traditional hardware spending to a mix shift to AI. But the other thesis that's going around right now in the investment circles is that, well, it could also mean that they're going to spend less on software as well, right? So from a larger perspective, there might be spending that's being pulled away from software to build out the infrastructure. Over time, as more software becomes AI enabled, the investments are going to flow back to software.
So the whole thing with NVIDIA, like trying to talk about software and not hardware as much, what is that?
Oh, yeah. So there actually is NVIDIA is also a software name, right? You actually need to build code to drive the GPU chips very efficiently, right? And the bigger the developer user base, right? Think about it as a programmer for Microsoft or a programmer for Oracle, right? You're trying to build this big developer user base so you can have your AI programmers to write to the NVIDIA chipset, right? There's two benefits to this. One, the AI chipsets try to leverage the software to optimize the energy consumption. So there is an energy benefit to this. And also, two, you're trying to lock up more developers to write to the NVIDIA GPU so you can gain or grow your market share in the GPU space.
All right, we're seeing more and more ways to play AI. I mean, there's the chips, there's the hardware, the software.
I don't know how he keeps it. I don't know how would you keep it all straight. I got to be honest.
He's a smart guy. Woo Jin Ho, thanks so much for joining us. Woo Jin Ho, he's a senior technology analyst at Bloomberg Intelligence. He's down in our Princeton, New Jersey office here, giving us some more views on how various companies within the tech stack, as the tech geeks say, in this case, Dell Computer, Supermicro, stocks moving today on more servers being installed for the folks that run these big models.
it just goes again, and then you pair that with those that just watch momentum and bubbles, and they get increasingly worried. So it's really hard to square those two at the end of the day. All right, this is Bloomberg Intelligence on Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Shares of Dell are on the rise, are up about 0.7%. This is after CEO Michael Dell posted on X that his company is building a Dell AI factory alongside NVIDIA for Elon Musk's startup xAI. We get reaction from Bloomberg Intelligence tech analyst Matthew Bloxham.
I think it's a real kind of big milestone for what's to come over the next 12 months or so, with Elon Musk investing aggressively into that Grok AI platform to become a rival to OpenAI. So I think there's going to be an interesting dynamic as we move into 2025.
Now, Elon Musk responded to that post from Dell saying that Super Microcomputer will be providing the servers, and that has shares of Super Microcomputer up more than 7%. While the families of victims of two deadly Boeing 737 MAX crashes, they're asking for a hefty fine against the company from the Justice Department. Bloomberg Government's Jack Fitzpatrick.
The victims seeking nearly $25 billion in damages as a fine, actually, that would be imposed by the Justice Department. Now, the lawyer for those people suggested that most of that money, between 14 and 22 billion, could be suspended if they dedicate those funds to safety improvements, an independent corporate monitor.
Boeing down about 0.7%. Hertz is looking to raise $750 million in a two-part junk bond offering as it works to boost its balance sheet. Hertz shares down nearly 3%. And to earnings we go, where Darden Restaurants, you know, the owner of chains like Olive Garden, well, it reported guidance that missed estimates, but it beat on profit for the latest quarter, and that has shares higher. They're up about 1.5%. Shares of Kroger, though, they're falling. They're down about 3%, and this is after reporting a meager sales growth. And then finally, recreational vehicle Winnebago posted quarterly profit that missed estimates. That's your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy longest day of the year day, solstice day right here in the United States. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and analysis through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. And we also keep you up to date on world and national news with Michael Barr. Michael?
Thank you very much, Alex, Paul, and Lisa. South Korea says it will consider sending arms to Ukraine after Russia and North Korea rattled the region and beyond by signing a pact to come to each other's defense in the event of war. The comments from a senior presidential official came today, hours after North Korea's state media released the details of the agreement. Observers say it could mark the strongest connection between Moscow and Pyongyang since the end of the Cold War. An American soldier has been sentenced to nearly 4 years in prison in Russia. The charges against Gordon Black involve an alleged altercation with his Russian girlfriend. Staff Sergeant Black was detained in May after traveling from his base in South Korea to Russia without permission from the military and without heeding the strong warnings about travel to Russia from the U.S. State Department. Melody Jones is Gordon Black's mother.
Feel like part of my heart's been ripped out and it can't be replaced until he comes back.
Jones says she warned her son not to go to Russia. Louisiana has become the first state to require that the 10 Commandments be displayed in every public school classroom. Republican Governor Jeff Landry signed the bill mandating the displays.
Because if you want to respect the rule of law, you got to start from the original lawgiver, which was Moses. That's right. Amen.
The GOP drafted legislation requires a poster of the 10 Commandments in large, easily readable font in all public classrooms from kindergarten to state-funded universities. Civil rights groups, including the American Civil Liberties Union, promised a lawsuit. The U.S. Supreme Court upheld a 2017 tax on American-owned businesses' foreign profits, rejecting an appeal that could have saved companies hundreds of billions of dollars. Voting 7-2, the justices said Congress has the constitutional power to tax people and companies on their share of undistributed corporate income. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex, Lisa.
All right, thank you so much, Michael Barr. Here's a story that really blew my mind. Gilead Sciences' experimental twice-yearly shot prevented 100% of HIV cases in women and adolescent girls in Africa. This could be an enormous new drug regime for fending off that virus. And it struck me because I feel like every generation has the thing. So when my mother was growing up, like in the 40s and early 50s, it was pregnancy, right? It was like, how do you deal with that? When I was growing up, it was HIV and AIDS. I feel like now my daughter is going to be fentanyl. Like everyone, I feel like every generation has the thing. So the fact that to see this headline cross is just blows my mind. It's unbelievable.
Yeah, and particularly in that part of the world where AIDS is still, I'd say, much more of a prevalent problem than it is maybe in some of the other parts of the world, like the West. So that would be just huge there. And it just feels like there's a lot of good stuff coming out of biotech and big pharma. I mean, just think about with the COVID vaccine, how quickly they were able to get that to the market. And we talked to Sam Fazeli at Bloomberg Intelligence, who follows big pharma, and he tells us there's a lot of really good, meaningful progress being made on a lot of fronts. And so, but like this is certainly one area. It's kind of fallen out of the discussion here in the West a little bit. Treatment of AIDS and HIV because of the drugs cocktails are working so well, but in other parts of the world still front and center.
And apparently HIV still newly infects about 1.3 million people a year worldwide. And that, like you mentioning, the current drug treatment is effective, but this is now a different way to prevent the disease. A vaccination has not been developed, but at least this is a potential option. And it's an injection, right? It's not like daily pills or anything like that. So I don't know. This just really blew my mind. I mean, really game changing on that level. We have some fun stuff coming up. Speaking of fun things.
Oh yeah, we got a lot of stuff going on. So we're going to talk about the restaurant business coming up. We're going to talk to Barry Ritholtz because it's Thursday.
Today is Thursday.
Yes, I always talk to Barry Ritholtz on Thursday.
And we're also going to talk about a really cool hyper truck and then how that's not really profitable. That's next.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Thomas Healy. He's the founder and CEO of Hyliion on the importance of capitalizing on off-grid power generation. We talk about power and the grid and the importance of the grid during a major heat wave across most of the country. So this is a timely discussion. And again, we will check in with Barry Ritholtz, founder of Ritholtz Wealth Management, see what's on his mind as he thinks about these markets. And Michael Halen's going to join us. He's a Bloomberg Intelligence restaurant and food service analyst. I wanted to ask him about this. McDonald's, $5. For $5, you get chicken, fries, and a Coke.
That feels like a good deal,
Feels like
right?
a great deal.
Feels really good.
So that's good for us as consumers, maybe not so much for Lisa Mateo.
Or my tummy. But yes.
Right, but not so good for the restaurant company. So we'll talk into Michael Halen about that. But right now, let's go to Charlie Pellet for a Bloomberg Business Flash.
Now we are looking at the S&P 500 index right around 5,500. We are brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Stocks, however, struggling to gain much traction after a rally that drove the market to records. Recent data mostly pointing to economic weakness that could hamper the outlook for corporate profits. S&P right now at 54.97, up 11 points, a gain of 0.2%. The Dow up 69 now, also higher by 0.2%. Nasdaq up 39, an advance there of 0.2%. 10-year at 4.27%, with a 2-year now yielding at right now 4.74% on the 2-year, and spot gold up 1.5%, $23.63 the ounce. West Texas Intermediate crude back above $82 a barrel now, up by 0.8%. Bottom line, stocks higher. Sam Stovall is Chief Investment Strategist at CFRA, and he told us, given the market gains in recent sessions, it is time for investors to prepare for a pullback. We'll get to Sam Stovall a little bit later on. So again, recapping, stocks higher, S&P up 9, gain there of 0.2%. Briefly, new home construction slumped in May to the slowest pace in 4 years. And that is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet, Alex Steele, Paul Sweeney. This is Bloomberg Intelligence Radio live in the Interactive Broker Studio right here in Midtown Manhattan. Happy also solstice. Apparently, the sun will hit its highest point in the sky at 4:50 p.m. Eastern.
Nice.
What does that? I mean, do we have lunch at that point? Like, what happens? You go to sleep early. What's that going to look like?
Well, yeah, I'll be on the beach at 4:50.
Yeah, you will.
Yes.
You definitely will. He has the outfit, so we're definitely good for that. So NASDAQ reclaiming the green here, up by 0.1%. Let's go to Vince Signorella, Bloomberg macro strategist, joining us. Vince, what are you watching today?
Well, I guess it's hard not to watch NVIDIA. There's a really interesting point. And, you know, the word bubble definitely comes to mind after this note by Jim Reed of a Deutsche Bank strategist, basically saying that NVIDIA's rise to the most valuable listed company puts the market cap of the U.S. chip maker above the entire value of the UK and French stock markets. Now, I don't know about you, but for one stock to be bigger than the entire value of both the French and British stock market seems a little lofty to me.
Yeah, it does. And, you know, we had a senior strategist, Vince, from BlackRock, a little financial institution called BlackRock, in our studio today, and we asked her for kind of best ideas, and they're saying we're still all in all things AI, NVIDIA included. A lot of smart people are riding this thing hard, you know?
Yeah, you know, everybody wants to go AI with everything, and everything is going to me, it seems like going to get a little bit more expensive with all of this investment. You keep building all this really, really fancy stuff that becomes very expensive. I don't know who's going to be able to afford it in the long run. I mean, Citi was out with a note this morning basically saying they thought the banking industry was going to be hit the hardest in terms of jobs from AI. So there are so many trade-offs with this, and it's such a new industry. And again, it just seems like there's so much froth in it, which with everyone just jumping in with both feet.
Yeah, I saw that. I saw that Citi report, and it reminded me back to my days as a junior banking analyst, how many pitch books I created. And you know, the first time I did it, it took a week. By like the third or fourth week on the job, I could punch them out in a day.
So is that going to be AI instead? And not
yeah, they're going to put me out of those young bankers out of a job making AI.
Yeah, but maybe the hedge funds will get them and go through that boot camp. That was a really fun story to read as well. So Vince, I mean, the thing is, it feels like everyone knows that these stocks are in a bubble, but that bubble doesn't mean it's going to burst anytime soon, and we don't know what a burst would even look like at that point. So how are traders managing that?
You know, I very, very carefully. I mean, they are dipping into this, absolutely, but I don't think they're not staying with it. So it's kind of an in and out kind of trade. If they can grab a few bucks out of it, they do. But in the long run, no one seems to want to hold this on a long-term basis. You know, I mean, that's the trader base. The investor base obviously does. And you know, talking to people, and they're starting to say this is getting to be reminiscent of the late 60s. You know, that 67 to 1970 period where stocks really rose dramatically, but then fell dramatically towards the end of the decade into the 70s. A lot of spending when you look at the federal government, both on the domestic infrastructure and such, and in, you know, sort of the guns and butter narrative. You know, typically, you know, the economists like to explain that you can basically expand the deficit in one area or the other. And this is very reminiscent of the Johnson era 60s, where we're sort of spending on both. And I think that makes the Fed's job incredibly difficult about inflation coming down to this 2% target, which seems more and more unlikely. And as one trader noted today, which I thought was really intelligent, was, does 25 basis points really matter at all when you're about 3% away from the target? I mean, what is that really going to do for you in terms of, other than the psychological boost of maybe they're now on an easing cycle?
Yeah. It's an interesting point, and I think the idea is like, okay, well, if you get one, like maybe it affects housing, like maybe it does something else, but like next year, does it matter if we get 3 or 4 or 2?
I think getting 3 or 4 or 2, or like the 3 or 4 means that the economy is really rolled over and growth is stalled considerably. And if that happens and inflation still stays sticky, you know, welcome to the 1970s. I mean, that's an even worse scenario. As Paul undoubtedly remembers, as I do, it took a long time to get out of that hole. It just doesn't feel like, I don't know, maybe I'm one of those, I hate this rally so much, but it just feels like there's so many things that's standing in the way of this continuing undaunted.
And that's why we go to Vince. We go to Vince for the joy and the happiness
exactly.
in this market.
Of a grizzled trader.
Vince Signorella, Bloomberg macro strategist. We always appreciate you. Thank you so much. All right, joining us now is a very special guest. It's Thomas Healy, founder and CEO of Hyliion. Now, Hyliion is quite interesting because I covered this company a few years ago when it was a long-haul EV trucking company. They had a powertrain that they were calling the Hypertruck ERX, and it was going to be an EV trucker, and it seemed like it had a lot of legs, it had a lot of interest, and then the company pivoted instead to become basically a power generation company. And it's a really interesting pivot. Yes, there's some similarities, but a really interesting pivot nonetheless. And Thomas joins us now. What's happened in the last few years? Tell me about your business shift.
Well, Alex, you outlined it perfectly. So, the last handful of years, there's been so much momentum behind EV, specifically in the trucking space. But the reality is, over the last 12, 18 months, we've seen a continued decline to the point of many of the companies in the space are facing bankruptcy or have already filed for bankruptcy. They can't raise additional cash. And so we were in a unique position where we still had a strong balance sheet. We had about $300 million of cash on our balance sheet starting at the beginning of this year. And we had a unique technology in-house as well that is a generator, basically a mini power plant that can be deployed outside of commercial buildings, data centers, EV charging sites. And so we saw that it was best to pivot the company to focus on that and actually move out of that EV semi-truck space.
All right, so you have this Carno platform. Tell us about that.
Yeah, so think of it as, a power plant that's the size of like the bed of a pickup truck almost. It can produce 200 kilowatts of power, and it's designed to be able to be stacked together. So if you think of an EV charging site, you're maybe going to need a couple of megawatts of power, so maybe 10 Carno generators. Or if you think of a data center, you maybe need 40 megawatts of power. But if you then go to the other end of the extreme, you think of like a commercial like store, like a Walmart or a place like that, you're going to need about that 200 kilowatts of power size. So our thought is you come in and you actually make this generator your primary power source, so you remove your dependency from the grid. You can actually make electricity cheaper with this genset than most electricity costs out there. And now you kind of have this model where you now make power outside your building, and you use the grid as your backup power supply.
So the two things kind of relate together, is that what was wrong with the EV trucking part? Was it that it was too expensive to build at scale, or was the demand not there?
Yeah, so 5 years ago, fleets were saying they're going to buy EV trucks in mass volume, and that, by this time, most trucks being sold were going to be EVs. The reality is EV adoption has gone extremely slow, and fleets are saying, we're going to buy onesie, twosie, try them for a little while, maybe we'll buy more. But what's really happened is people are waiting until the government mandates that EVs need to be adopted, and we're seeing those dates continue to get pushed out to the right. And in addition to what you mentioned of the cost of EV trucks have continued to go up as well. So we're really just seeing this situation where adoption isn't happening anywhere near the rate that was initially expected. And so being in the public markets, the companies needing to raise more cash and stock prices continue to decline, we just thought it was best to get out of that space and focus on an area where there's actually a lot of momentum, right? We talk about AI, that needs a lot of power generation.
So what can you take from the EV trucking to the power world? Like, how were some things transferable?
Yeah, so this generator, the Carno, was actually something we acquired out of GE, and it had been a project that we were working on with General Electric for a few years, where we were actually going to put it as the generator inside the truck to charge the batteries while you were driving. And so we acquired it out of GE a couple of years ago, and we always saw it as a solution initially for trucks, but we could go into the power generation space. But as we've kind of seen the market shift, we saw that just going after power generation and stationary power first made a lot of sense. And then it's still a technology that we see could be viable for the EV trucking space down the road.
Talk to us about, again, on this new energy platform that you have. Where are you in terms of in your timeline of deploying these, making sales? Who do you target to sell to, that type of thing? Where are you in the development there?
Yeah, so we're at a point where later this year we'll actually be getting units out into customers' hands. So it's been a north of 5-year development program, both when it was in GE and now at Hyliion. And so we're right on the cusp of just about to start getting units out there to customers. A few key markets we're going after. One is that EV charging space. Another is actually using waste gas. So if you think about like oil and gas sites, they flare a lot of gas right now. The Carnot generator can actually be a great way to take that gas and make electricity out of it. We're going after commercial applications like data centers, commercial warehouses, hotels, hospitals, those type of applications. And then another one which is kind of unique is actually the marine space, so powering ships and vessels off of this genset as well. One of the unique things with it that we haven't talked about is it's a fuel agnostic solution. So it can run on futuristic fuels like hydrogen, like ammonia, but can also run today on fuels like natural gas and diesel and propane. And so for customers, you're kind of getting this like future-proof solution.
That's interesting. So it is transferable. What is the demand like?
Yeah, so power generation demand is very strong right now. I mean, just to share an example with you, like we obviously knew the EV trucking space well. When people would go talk to their utilities about getting a grid interconnect, trying to get electricity for their chargers, they're being told it's like 2 to 3 years just to even get access to the power to get connected to the grid. And then in some instances, some parts of the country, there's being told there just isn't enough power available at all. So, we see a few things happening where you've got EV charging, you've got AI for data centers, you've also got industrial applications moving over to electric. So the demand on the grid continues to increase, but we're also in a position where new power plants aren't being made and infrastructure isn't being upgraded at the rate that it needs to be. So that's where we're seeing the market really shift to these kind of distributed power generation models where you make your own electricity locally to power your facility as opposed to being reliant on the grid. And so, we see a massive shift happening to that sort of market over the next few years here. And it's already started, which is great to see.
So, I mean, you called out one of the big headwinds, I guess, facing the EV business today, at least here in the U.S., and that is whether the U.S. electrical grid can even support the transition to EVs. You're down in Texas. You guys have your own grid, but how about just the big picture? Can the U.S. grid support the transition to EVs?
I think it's going to be a tough one without this distributed power generation model. Just this morning in Texas, we had a power blip at this facility. I was on a call this morning with a colleague in Michigan. Her power was out. So, I mean, the reliability of the grid is a real problem right now. And one crazy stat is if you plugged in 10 semi-trucks into the grid, that would consume as much electricity as the entire Super Bowl stadium during game time. So it's a crazy amount of power that these trucks will draw, and I don't think the grid's able to handle it today, at least not universally across the country. And if you do want to support that type of demand, you need not only the power plants, but then you need to go build transmission lines. You need to set up the local infrastructure. So it's kind of this ripple effect versus you could just put this generator down and start making your own electricity locally.
It's really interesting stuff. I wish you luck on this one. Let's check back in and see how it's going. I know that this is all a huge transition pretty much for everybody, and companies included. Thomas Healy joining us, founder and CEO of Hyliion, joining us. But it's so interesting, right? Because I just think his transition is so interesting because it's too hard.
Yeah.
EVs are too hard. If the demand's not there, how do you stay in business?
I don't know how you do it as a public company. I know the stocks have been down, and they've been drawing down on their cash that they got from their IPO. I'm not sure if that was a SPAC or not back in the day, but that's kind of an interesting test case to see how a company, as a publicly traded company, can completely pivot the business that it's in.
And remember, too, like Tesla, yes, it makes cars, but it's also a storage play.
Right.
Like, it's also a battery storage company, and in which case you wonder, like, where the value of EVs actually is. Anyway, coming up, Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business, will be joining us. His latest commentary on the market. It's always entertaining. We want to hear what people are talking about and the broad themes within the market. We all know NVIDIA is higher, so let's get more to the guts of the market. This is Bloomberg Intelligence on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We got the S&P 500 index at 5494, briefly crossed 5,500. A gain right now of 7 points, up by about 0.1%. Dow Industrials up 73 now, up 0.2%. While NASDAQ is up 12, a gain of 0.1%. 10-year 4.26%, the 2-year 4.74%. Gold up 1.2%, now $23.55 the ounce, up $27 now. And West Texas Intermediate crude up 0.8%, $82.20 for a barrel of WTI. Kroger shares are trading lower, down 2.3%. Kroger sales did inch up as consumers kept purchasing groceries and other essentials. The largest supermarket operator said comparable sales rose 0.5%. Kroger runs several grocery chains, including Ralph's and Dillon's. It's trying to become an even bigger presence in the U.S. by acquiring Albertsons, and Albertsons shares, they're lower now by 0.5%. Recapping, S&P up 5, up 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. So you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. All right, you know, the story for the last 18 months, folks, let's be honest, has been NVIDIA. That's all people want to talk about. It's certainly had a significant impact on the overall performance of the markets. It's now become, you know, larger than the biggest tech names out there. So just an extraordinary story. But for every person that's out there buying it, it feels like we have a conversation with somebody that says, boy, this is the top. This is a bubble. It's got to break. I'd like to get the opinion of our next guest on this. Barry Ritholtz. He's the host of Masters in Business on Bloomberg Radio, founder of Ritholtz Wealth Management. He's been around the block once or twice. He's seen bubbles in various asset classes. Barry, how do you talk to your clients about NVIDIA, about some of these AI stories that are sending some of these stocks to just extraordinary levels? How do you frame it out for them?
So there's a couple of different ways to describe this. The first is, hey, every market ends when just a handful of stocks are pulling along the rest of the train, and we're not there yet. There's still too much participation. NVIDIA isn't quite Cisco. If you remember, Cisco pretty much was the last of the generals to mark the end of the 90s boom. But the bigger picture is, don't think about NVIDIA as an AI stock. Think about the impact of things like